the special meeting of the Budget and Finance Commission for May 27th, 2021. Marty, may we please have a roll call?
Commissioner Johnson?
I think you're muted, Steve.
Yep. Well, it took me only 10 clicks to find the right microphone to unmute myself, but it is affirmative that I am here. Thank you for your patience.
Commissioner Marin?
Here.
Commissioner Wynn?
Here.
Commissioner Samples is absent. Commissioner Solomon?
I just saw him, so he must have stepped away.
Here, I'm here.
There we go.
Commissioner Woodham?
Here.
And Chair Conroy.
Here. All right. Next, please join me in the Pledge of Allegiance. I pledge allegiance
To the
flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, moving on to item D, approval of the order of agenda. Would anyone like to change the order of agenda? Seeing none, may I get a motion to approve the order of agenda?
Motion approved.
Motion to approve.
A second. Second, please, gentlemen.
Second.
From Commissioner Wynn. All right, and then we will do our first roll call vote. Commissioner Johnson?
I'll stay unmuted. That's an aye for me. Thank you for your patience again.
Thank you. All right, Commissioner Marin?
Aye.
Commissioner Woodham?
Aye.
Commissioner Wynn?
Aye.
Commissioner Solomon?
Yes.
All right, and chair votes aye as well. Thank you. Moving on to item E, blue folder items. I see we received blue folder items for item J1 and J2. Marnie, are there any other items that you're aware of that we'll be reviewing tonight? Not currently in in our agenda.
Yes, I believe Dan Masiello from Cosmont has a presentation, a short presentation, and so we'll need to blue folder that as well.
Will we be getting that emailed to us?
Yeah, it'll have to be after the fact, though.
After the fact?
Sorry, I turned it in a little bit late, but you'll see it.
Okay. Will Dan be part of our J1 presentation with
Yep.
Ramirez? Yes?
Yep.
All right. Okay. Other than that, seeing no other blue folder items tonight, is there a motion to accept the blue folder items?
So moved.
So moved.
A second.
Second.
All right. And roll call vote. Will Commissioner Solomon, please?
Aye.
Commissioner Woodham?
Aye.
Commissioner Johnson?
Aye.
Commissioner Marin?
Aye.
And Commissioner Wynn?
Aye.
Chair votes aye as well. Thank you. Okay, that brings us to our consent calendar. There are 2 items on the consent calendar this evening. These will be approved in one motion. Would any member of the commission like to pull any consent calendar items for discussion at this time? Okay. Do we have any public comments on the consent calendar? All right. Okay, with that, can I get a motion and a second? To receive and file. Yeah. And a second, please.
Second.
All right. Roll call vote. Commissioner Johnson, please.
Aye.
Commissioner Merritt.
Aye.
Commissioner Woodham.
Aye.
Commissioner Wynn.
Aye.
Commissioner Solomon.
Aye.
Chair votes aye as well. Consent calendar items are now received and filed. All right. We don't have any excluded consent calendar items, so we'll move on to item H, public participation on non-agenda items. This section is intended to provide members of the public with the opportunity to comment on any subject that does not appear on the agenda for action. This section is limited to 30 minutes. Each speaker, including those by Zoom, will be afforded 3 minutes to address the commission. Each speaker will be permitted to speak only once. Written requests, including email comments, if any, will be considered first under this section. Commissioners cannot comment on non-agenda items, but may request that something be put on the agenda for a future meeting. With all that being said, do we have any public participation of non-agenda items tonight?
There is none in Zoom.
Okay.
We have no e-comments.
Thank you, Marnie, and thank you, Doug. All right. Next, item I. Next on our agenda are items continued from previous agendas. Would any commissioners like to recall any items from previous agendas for discussion at this time? Seeing none, then we will move on to items for discussion prior to action. Starting with item J1, discussion and possible action regarding refinancing the city's CalPERS unfunded accrued liability with bonds, which will be presented by Marnie, Dan Masiello, and take it from here, Marnie.
I will start it off.
Thank you.
Good evening. At your last discussion regarding bonds, you made a recommendation to the City Council for underwriting firms. Consistent with your recommendation, Council approved Stiefel and Ramirez as joint senior managers. And in that short amount of time since then, a lot of work has been done with both underwriting firms. In addition to the bond document preparation that the whole financing team has been working on, today Stiefel filmed interviews for an investor video that they'll be putting together. And Ramirez and Company has been working with Cosmont Transaction Services in performing analyses on the various structuring options. So tonight we have with us again Dan Masiello from KTS, and we also have with us folks from Ramirez and Company. So I'll start by turning it over to Dan to give you a brief overview of the analysis, and then he'll introduce you to the Ramirez representatives.
Thank you, Maureen. Good evening, commissioners. I'm happy to be with you here again tonight. Can everybody hear me okay?
We can.
Great, thank you. So I'm going to be sort of quick because, I am not the headliner tonight. Our headliners are really the Ramirez team. We're working really hard on coming to some conclusions. But as Marnie pointed out, we've been going through a process. I want this to move. There we go. We first came before the commission back in January, if you can believe it, back when it would have been pitch black right now. And we brought the concept for discussion before your commission and the city council in late January for the commission, and mid-February for the council about the concept of refinancing the city's UAL for budgetary savings. And the commission accepted the council's recommendation that the item move forward for evaluation and to explore the options available. Staff and KTS then solicited statements of qualifications from underwriting firms, as Marty mentioned, and based on commission's recommendation to council, and council directed staff to hire the underwriting firms of Stiefel and Ramirez, and we've been working diligently to evaluate structuring options, funding options for the UAL, and various other items related to whether or not to issue bonds and how to do so. In addition, in order to evaluate one of the questions we're here to consider tonight, KTS has been working diligently to evaluate the city's available assets should it decide to continue with or go on a lease revenue bond path to finance the UAL versus a pension obligation bond. And we're going to discuss that a little bit tonight. And in addition, as been mentioned, Ramirez has been doing the heavy lift, but we've been analyzing diligently the various math involved with funding levels, repayment levels, and whatnot that we're going to go over tonight. So just real quick. the first question at hand, as you might recall from the last meeting, that we said we were going to come back to the commission and then council to seek input on some kind of major structuring items. And the biggest one really is, kind of officially, do we want to go down the lease revenue bond path or a pension obligation bond path? And so just as briefly as I can, to lay it out, and we'll take some questions right after this before we get into the meat of the Ramirez presentation, excuse me. The city has to have a means to legally repay bondholders. And in California, there are very limited options. And basically, you can have a vote or the people, or issue something called a general obligation bond by various means, which we'll get into in a second, or you can issue something known as a lease revenue bond. General obligation bonds can only be authorized and issued if there is a vote of the people, or if there's an item that's validated by the court, generally applying to a debt that's already existing, and then simply refinanced under the state's refunding laws. But this process, as we mentioned before, is long. It takes at least 3 to 5 months just in the court alone before we could even begin to issue the bonds or conclude the bond issuance process. A lease revenue bond is basically a bond where the issuer, which would be the city's community financing authority, would pledge rent payments to be received on a leased asset to bondholders, to bond investors. And the way it works, real briefly, is that the city would transfer the possessory interest of an asset that the city owns over to the community financing authority, and then the city would lease that asset back. And guess what the rent payments are? The rent payments would be equal to the bond payments. But this is all regulated. It needs to be, it's a real lease. It has to be legitimate. And so the standards that have been established through case law and various other procedures basically are that the bond payments need to be or represent a fair rental value. And it has come to be the standard that the value of the assets must be greater than or equal to the actual bond amount. And that is kind of the determining factor in how, whether or not a lease can be the size that we need it to be. So KTS has been evaluating the city's asset pool, and we have made a couple of determinations, and we've been working in concert with Bond Council as well to determine what is legal and not legal. And without spoiling too much of the surprise and reviewing too many proprietary sort of devices we've been employing, we are comfortable to say at this point that we have determined that the city in fact has more than adequate lease assets that are available to be leased. One of the questions that was, or one of the concerns that have been expressed is if the city uses its assets to fund this project or to fund the refinancing of the UAL, to back the refinancing of the UAL, would the city have enough assets remaining should the city need to embark on some capital improvements in the future? And we're very comfortable to say, yes, in fact, that issuing lease revenue bonds against the assets we think we'll be able to, feel very comfortable be able to utilize, would not deplete the city's asset base in any meaningful way and would not prevent the city from having a robust capital improvement plan in the future should it choose to embark on one. We also believe that any differential in interest rates would be very minimal, if any, almost immeasurable, very hard to determine, so we will call that de minimis. And the main factor here is really one of timing. A lease revenue bond would be able to, we're in the middle of doing it right now. The process we're in will continue in earnest, and we are projecting to be able to close, barring any unforeseen events, in about mid-July, whereas a pension obligation bond, we will be getting out of court maybe in the beginning of the fall, and then an issuance in the middle of fall, hopefully before a holiday. So that's really the biggest distinguishing factor in terms of process. The major other factor would be the fact that a pension obligation bond doesn't actually need to do the lease to have property encumbered, but as I just noted before, it really should not impact the city's overall financial planning, whether or not it has certain assets that we've identified that are eligible for use. It won't, the encumbrance of those assets won't in any way, it won't impact the city materially for enacting any future capital financing plan. So this is one of the decision points that the commission will be asked to weigh in on tonight. It's a little bit different than the rest of the discussion we're going to have. So I'm going to go ahead and stop right there and just see if anybody would like to have any discussion or has any questions.
Yeah, I have a couple of quick questions.
Yes, sir.
The first one is it relates to, I'm glad that, we looked at the unencumbered assets of the city, and we have it sounds like we've got a better idea of what those are. And So my first question is, you said it's, with this bond issuance, there's still going to be ample unencumbered assets remaining. Can you put some sort of fuzzy number to that? Like, would we be, with this bond issuance, are we encumbering roughly 10%, roughly 40% of the unencumbered assets? Like, what are we talking?
Yeah, really good question. So traditionally, other cities, so let's take Torrance, for example, your neighbor. They did the lease revenue bond approach for refinancing their UAL. They pledged their streets, but what they pledged is they pledged the street material, the concrete, the asphalt itself. And we've proposed that, that's fine, but that ignores the value of the real estate the street sits upon. And we're pretty confident, and through our exploration and our research and discussion with attorneys, title companies, we feel very confident that we can move forward in pledging and using as an asset the actual real estate the streets are sitting on. As a matter of fact, we think that the security structure will be a little stronger if we ignore the value of the asphalt on top of those streets. So that's the process that we're going to continue on now. That valuation number is tricky. So if we applied what we think is a conservative number of about $150 a square foot as a real estate value in Redondo Beach, and there are numbers much higher than that, and a few numbers comparables we found that were lower than that. But to be somewhat conservative, we're looking at a value in the billions, approaching $3 billion. Now, is that the right number? Should it be 75 because it's not an asset you could actually transfer in a real arm's length transaction? Those finer points are being worked out with bond counsel still, and I'm sure that Raul and his team are going to want to weigh in on the credit side of that analysis. But, let's say it's half of that. Let's say it's $75. We're looking at over $1 billion, $1.5 billion of street asset value alone in the city. And so $200 million would be a fraction of that, 10 to 30%, I think, at most, depending on what the actual valuation and what we can't possibly practicably fully analyze the street inventory of the city and determine every single street that might be eligible, right? So there could be streets that aren't eligible. We don't really know, but we're going to focus in on the plan is at this point, specific streets that would be very clear that they're able to be leased, that the lease that would be associated, that the city would be legally able to lease their interest in that property and then lease it back without any defects or flaws or problems. So it's hard to put an exact number on that, Commissioner Conroy, but I think it's safe to say we're not even approaching 50% yet. So
no, I think you gave a great answer there. Okay, just briefly, LRB versus PLB, as far as the administrative costs, are they also very similar in nature, or is one going to cost quite a bit more than
administrative, meaning for issuing the bonds, or ongoing from the city?
Ongoing.
The only ongoing cost the city would incur would obviously be debt service payments and some housekeeping items like paying the bond trustee and paying to publish disclosure reports annually. So yeah, those are identical.
It'd be comparable between the two issues.
Identical, actually, I think, just in terms of managing a bond issue. I can't think of a reason they'd be different. Yeah.
Those are my two questions, and I see some hands raised, so I'm going to call on them in the order they went up. So Chairman Solomon, Commissioner Solomon.
Thank you.
Former chair.
Old habits.
I was promoted. Thank you, Chair Conroy. Two questions, please, Dan. One you may yet to cover. When we were having these discussions, there was an analysis yet to be done as to what the credit risk would be for the city. We were hoping for AA or AA plus. Is that something that would come later in the process, or is that begun and will be addressed later on?
The anticipated, so the process to establish the credit rating is part of the bond issuance process. And if we continue on the path of a lease revenue bond, and we'll point this out later in this presentation, that is anticipated to, right after the city council meeting of June 1st, which would be the meeting where the council considers the recommendation of this body, once we have clear direction, is So if the council says yes, lease revenue bonds, the very next day we're going to call up Standard & Poor's and say, we want a bond rating, please, and here's our information. And so that process will take place throughout the month of June. Based on my understanding and knowledge of what the city's budget is, finances, other cities, the city compared to other cities, I see no reason to expect that the city's credit rating will be changed either up or down. The issuer credit rating as it stands right now, if the city would issue general obligation bonds, would be AA+, one notch away from the highest possible rating of AAA. The lease rating, because of certain built-in risks based on the function and operation of leases, specifically, there's two risks. There's what's called abatement risk. If the city doesn't have beneficial use of its asset, it may not make lease payments. And the other one is appropriation risk, which means that every year the payments have to be budgeted, and that budget has to be approved by the city council. It's not a general obligation bond where the city is always legally required to pay. And that's a technical distinction because, in fact, the city would be required to pay contractually. And we feel that the structure we're employing, where we're going to use the real estate on which the streets are sitting, actually severely or significantly reduces abatement risk, because even if there was some major catastrophic event where the streets were destroyed, the streets aren't what's being leased, it's actually the real estate they're on. And if the city needs to repair those streets, it would need to keep making its rent payments and maintain interest, maintain possession in those streets in order to repair them. So that's the discussion we're going to have with Standard & Poor's. So I don't think that's going to convince them to give your lease bonds the same rating as your issuer credit rating, AA+. Certainly going to try, but I don't think there's going to be any negative impact from the approach that we're undertaking, considering to undertake.
The second question is a procedural question. And since Cosmont did this previously with our lease in the harbor and our consolidation of those, from a procedural standpoint with the Community Financing Authority, the council comes into session, they recess to the Community Financing Authority, they have a hearing about the lease revenue bonds, they discuss that and make motions and approvals, and then they recess back into a city council meeting. From a procedural standpoint, is there any thing that would hang us up? Is there they happen contemporaneously at the same meeting, or they can do? Is there something that needs to wait 30 days or otherwise procedurally is delays once the Community Financing Authority approves or gives an okay to work with the city in this way? Or
No.
all this can happen contemporaneously?
It's all happens at one city council meeting, and you'll be good to go after that meeting.
All right, thank you. That's all I have for now. Thank
You're
you.
welcome.
All right, Commissioner Marin, and you're on mute.
My question is, I get the concept that, the land definitely has greater value than the materials that sit upon it, the concrete or the asphalt. But is there a greater risk by encumbering the real estate versus, or what was the decision, that Torrance made in doing so? Or I guess in short, like, will this give us a better credit rating because we're...
I'm sorry. It's a little, no pun intended, groundbreaking, because, other agencies have not gone about it this way. KTS is kind of unique because we're one of, several Cosmont entities, and part of our focus is real estate. And so we have the real estate operations and a vast well of real estate knowledge and understanding of how that whole world works. And we've been working in close concert with Will Solholt, who you may know, who works with the city in a lot of consulting capacity for real estate projects and economic development projects. And I just frankly don't think it's been done this way before because it hasn't been thought of. And this is something we've innovated. We sort of did it this way 2 years ago, kind of had our foot half in the pool because we kind of did pledge the concrete itself and associated a land value, and it was a much smaller bond issue, $30 million versus potentially over $200 million. So this requires a lot more diligence, and we've had 6 or 7 phone calls with bond counsel on this topic. Specifically, yesterday we were discussing this with not only Russ Trice, who would be the bond counsel, but Norton Rose Fulbright's real estate attorney, to kind of make sure that how the city's interest in the streets works, how it's applied, what can we do, what can't the city do, and would this approach hold water? Would they be comfortable putting their legal opinion that the bonds are valid and legally binding? And we basically were told this morning that the Norton Rose Fulbright would be comfortable to proceed with this structure. So fresh off the press, hot off the press. We're still moving along, but this is somewhat of an innovation. We're pretty proud of it, and we're happy to see the path that we suggested is seeming to pay off so far. And stay tuned. We still have a little more wood to chop, as we say. I don't want to put the apple cart before the horse, but I feel pretty good about the place we are with this process.
Does that add any risk to the city, or do we get a better credit rating because we're offering a much more valuable asset?
Yeah, stay tuned. I mean, like I said, I'm certainly going to beat that drum with the credit agency. Say, hey, you have two main risks. The reason that you rate bonds a notch lower than general credit rating is because of abatement and appropriation. And what is a city without its streets, right? So why would the city ever not appropriate its lease payments? A, and B, where's the abatement risk? It's dirt we're talking about. And again, if the materials got damaged, if there's PCH wouldn't be one of the streets, on that. But, if the whole neighborhood, the streets got destroyed, the city would indeed need to repave those streets, and so therefore would have to, it's like a house falling down on your property. You don't lose the use of that property. You just can't go inside your house. So I would argue, and I don't know, considering it's a new approach, would this be enough of a factor to kind of circumvent a Standard & Poor's established rating criteria? I don't want to, promise that. I'm certainly going to try. But if anything, I think it's a credit positive personally. And, Raul Mezcua might want to weigh in a little bit in terms of what he thinks the bond market reception might be to this approach. I know he's on the line with us here, one of the bankers.
Sure. Yeah, I guess I would say, lease revenue bonds are an extremely common structure. I would say it is by far the most common way cities finance projects, from city halls, police stations, libraries, et cetera, et cetera. They've been used for many, many decades. And so when you say, well, what is the pledged asset? What are we leasing? It's kind of one of those things, right? The investor doesn't really have a mortgage interest in any property ever. So in theory, but in the legal documents, normally their only remedy if the city were not to pay is to sue the city every single year for the individual lease payments. So if you had a 20-year deal, that would be 20-year lawsuits, assuming a city refused to pay on day one. And secondly, they have this theoretical right to retake and relet. And I say theoretical because if you leased a courthouse, what would they do with it? If you leased a police station or city hall, would a judge actually ever allow that to happen? I think public safety would probably trump that. So it's just this imaginary security that the bondholders think they have, because they really don't have it. No one actually expects that they're going to take over a police station or a jail or a courthouse, et cetera, et cetera. In this instance, we're pledging streets, and we're telling the investors up front, oh, by the way, that theoretical right you have to retake and relet if the city were not to pay, you don't have it in this deal. So the city did a street deal, a lease revenue bond deal in 2020, and it pledged a street. And in that deal, it also told the investors, you don't have that right. So we're telling the investors, hey, we're pledging it as a lease mechanism, but you don't really have any right in security other than to sue the city for payments. So that's really the real nut of the gist of the credit, I would say. And for a city like Redondo Beach, that's a solid AA. Right. I don't think investors are concerned about, a default as they would in a poor community or in a city that's reliant on one employer or a city that's exposed to some environmental risk where the city could really face those kind of issues. For AA rated cities, I don't think that really is a concern. So hope that answers
that's the exact response we got in 2 years ago with the other financing, both from the credit rating agencies and the markets. There was a concern because it was sort of innovative back then too, and we're kind of expanding that innovation on this go around. And I spent several hours on the phone with the bankers on that deal because there was the concern that how can we remove this reletting concept? I don't know if anybody will buy it. And guess what? There are plenty of investors. The city did extremely well, got an excellent interest rate on that bond deal. So feeling pretty good about this process.
All right, Commissioner Johnson.
Well, I think Mr. Raoul just went into depth on explaining much of my question, but I do want to poke at it a little bit just to make, and I know we must all understand it, but the RB Community Financing Authority is really nothing more than a notional entity that's created to lease the assets and then lease them back. And to me, my questioning on this, and by the way, I accept that it's done and it's readily accepted, but as you said, you know, it's an imaginary security. Certainly, the streets as collateral are completely illiquid. They can, you know, whether business or residential, the residents and the businesses have 100-year expectation of right of way and usage of the streets, and nobody can come in and build something else on Redondo Beach Boulevard. So in the interest of not taking more time, Raul, I think you walked through that perfectly, and that's what I would have said, only with a question mark at the end. This is just an imaginary security. So thanks. I think we all understand that.
It's a constructed legal fiction that has been well established and accepted, and the courts have deemed it to be legal. There's actual case law on it. So yes, I mean, let's not make any bones about it. It's sort of a loophole driving a truck through, without a doubt. Yeah. Not trying to be coy or sly about it, but the fact is, the city retains full control. There is no third party. There's no toll booth that's going to be set up on Elvira Street or anything like that. It's a means to establish the cash flow that the city can capture and pledge to the bond markets.
Got it.
All right, thank you. Commissioner Solomon.
Thank you, Chair Conroy. And then I also like to refer to something Mr. Amesqua said, and I don't mean to upset Commissioner Johnson. I'm not trying to be flippant, I assure you. After the survey of assets, Mr. Amesqua referred to this being commonly done with city halls and libraries and police stations for lease revenue bonds. We have a lot of deteriorating asset like that, our city hall and our police station especially. Is there a benefit since the asset survey came back in the manner in which Mr. Maciel described in a pretty substantial way, to consider any other infrastructure funding at this time, an economy of scale, as it were, to doing this while we're going through the process, evaluating the assets, issuing the bonds? Is that worthwhile to have the city council consider, or at least discuss with them or posit to them?
Well, careful, Commissioner Solomon. You're asking a banker if you can issue more bonds. I mean, pretty sure what the answer is going to be there. But yes and no, in the sense that this is a specific type of financing. It's actually going to be taxable. The sort of infrastructure financing you're referring to would be tax exempt, so it'd be sort of a different plan of finance. Whether or not the city would like to undertake a capital improvement program, I think it's a very good question to ask. And as a matter of fact, there are certain other financings outstanding, one of which or several of which I believe assisted the Marine Avenue Hotel projects that actually encumbered City Hall and police station. I don't know if the police station is part of that, but other of those more traditional city assets are already tied up in leases. And so if the city were to desire to have a new city hall or reconstruct the current one or address other capital needs, this process that KTS has gone through and identified that will back these bonds can absolutely be replicated. And let me take it back to the absolutely part. We haven't crossed the finish line yet, so I don't want to jinx us, but we seem to be on a path where this will be successful. And if we prove successful, then the answer is a yes, that we could replicate this structure and approach for infrastructure financing on a tax exempt basis. I see no reason why we couldn't do that.
Okay, thank you.
And just put a
First
fine-
thing I thought of, yeah. Go ahead, please. I'm sorry.
I was just going to say for Dan, just to put a finer point on that, then, by replicating by doing a infrastructure bond in the relatively near term, does the city stand to save money because of efforts that were already taken to underwrite these bonds?
I'm not sure what you mean, Commissioner, about
Well, just as far as like, if we're using the same bond counsel and maybe some your services and so forth, all of the work that's going into being able to issue these bonds for our for UAL, can the city save some money in the near term if they decide to move forward with the infrastructure bonds because of work that's already been completed for these bonds?
Some, so for example, on this project, we have some real estate work that we've undertaken. That's sort of a separate fee, and it's not a lot, but that probably wouldn't need to be done again, although I can't promise that because a new set of assets for a new financing and a new set of legal documents, a new entire issuance process, there wouldn't be too many economies of scale to capture, but it wouldn't be like a completely blank slate either, I think, to your point. So, if it's not difficult and we're not inventing a new wheel, then it shouldn't be more expensive. I don't know if it would be any dramatic savings because it would be a completely different plan of finance, a different strategic use, different use of the proceeds, different kind of perspective. But, considering that we had to,
perhaps some, but if there is, it wouldn't be.
It wouldn't. I don't think it would be the deciding factor of whether or not to move forward for you.
Gotcha.
But we believe in volume discount pricing, so we would certainly hold everybody's feet to the fire a little.
Appreciate that. Okay. I don't see any other hands up at the moment. If you want to proceed with your presentation?
I'm sorry, question. I can't find my thing to turn it on, so I just raised my finger. Dan, a quick question. You mentioned a moment ago something about a likely schedule for the issuance of the bonds, and I missed those dates. Could you repeat that?
Oh, well, we were talking about the credit presentation and the credit process, so that'll happen throughout the month of June, and we'll go over that at the end of the presentation, Commissioner Woodham, but, we're basically aiming towards closing in mid-July. If we stay on track of the schedule and it is a lease revenue bond deal, we believe we can conclude this by mid-July.
Okay, earlier on, we were doing lease revenue bond issues because we could do it by the end of June. Does this change that schedule? Do we have to make part of a payment to CalPERS?
Oh, good question. So the date by which the city has to, so there's two dates, June 24, I think it is. The city right now, it's kind of like the closing of your credit card statement, right? The CalPERS period, the billing period is going to close on June 24th. And if there's not a payment made or to pay down the UAL or pay off the UAL by June 24, the fiscal year 22, which is upcoming, UAL amortization payment will become due and payable to CalPERS before the end of July. So if the city pays that payment before the end of July, it will recognize a 3% discount. So instead of making one payment, let's say June 23rd, for the whole UAL, we'll actually have two wires. We'll have to ask the underwriters to make two wires. One will be to pay that UAL payment, the amortization part, and then the other would be to pay the UAL outstanding balance. So materially, it's just not really going to make a difference. We're still going to beat that July 31st deadline and get a 3% discount if all things stay on track.
So same total payment, just in two different wires.
Essentially, correct. I mean, the amount due changes by the day, kind of like your car loan. You call up and say, what's my buyout price today? And next week it's different. So that all applies. But
okay, understood. Thanks.
You're welcome. Okay. So let's get right to it. So what have we been doing with Ramirez? Basically, the other part of the decision process that we're asking the commission to weigh in on tonight is the level of funding that the city should have in its pension plan. The levels of funding that were outstanding as of the last survey that was performed by CalPERS, the last calculation. The miscellaneous plan was 70.6%. The safety plan was 63.2%, which is a much, much bigger plan. So when you blend those two, it's actually total pension plan funding on an aggregate basis is about 66% for the city versus 100% of what the actuaries say you should have available in your pension plan. That has led to some questions about if we refinance at UAL, what happens if CalPERS underperforms or overperforms. And so Ramirez performed analyses that looked at bringing that funding level to the 80, 90, or 100% point, and also analyzed what the probability and impact of a potential so-called over or super funding scenario, which was 115%, and they'll get into the details of what that looks like. And then how would any different, funding levels or bond sizes affect the budgetary savings to be realized? And so those were analyzed as well. And so as I just said, these are the things you'll be hearing from Ramirez, and as we'll be discussing tonight, we'll be talking about repayment structure in broad terms. And so the buzzwords that you'll hear are, what is a level repayment structure? And that's basically just like your mortgage. You pay unless you have an ARM, but if you have a fixed rate mortgage, basically a level payment means you pay substantially the same amount of money each year until the end of the term. The term has been set up to be the same as the existing UAL repayment schedule, which runs through fiscal year 2049. We also have something called a hybrid. Excuse me, I'm going to sneeze. We have something called a hybrid repayment, which combines, excuse me, a level repayment structure kind of upfront, but then if you remember the graphs, and Ramirez will show you these, but that we had on our presentations, the CalPERS amortization is declining after a certain, it goes way up and then it starts to taper off. So the hybrid approach would basically set a level payment until the point where the amortization would have naturally tapered off anyway, and then we don't exceed those payment levels. So we have sort of a combination where we have a little bit more front loaded, but then it drops down. And then there's also the option for an ascending payment schedule, which is worth evaluating, at least discussing, because the fact is over time, the city's revenues in general could change from year to year, but over time they generally increase as do your expenses. And so to have an ascending payment schedule would align the payments for the pensions a little bit more with your anticipated revenue base. These all have their pros and cons, and Ramirez will get into them a little bit, just to give you sort of a preview of what you'll be hearing. But what we will need from the commission and then ultimately the council is some direction and input, so we can bring what this commission decides is appropriate to the council. These extensive analyses have been performed to provide the commission and the council with a very robust set of data, including multiple pension plan funding levels, multiple repayment structures, and multiple possible CalPERS investment return scenarios. I don't want to steal all Ramirez's thunder, but let's keep in mind that all these projections and everything we're discussing are, of course, projections and estimates. They are all subject to change. They were done in good faith, but doesn't mean that we can see the future. And we are, of course, here tonight to answer your questions about any and all of these topics. And without further ado, I'd like to hand it over to Ramirez to walk us through the analyses. And when they're done, we'll come back and we'll discuss next steps and entertain questions and discuss the schedule.
Thanks a lot, Dan. So my name is Mike Mejia, and I'm a senior VP in Ramirez's LA office. And on the line, we also have who you've heard from already, Raul Amezcua. He's a senior managing director here in California. He runs our entire California group. And you have also Al Quintero from New York. So he's putting the late night hours on the East Coast, and he runs our quantitative, our quant group essentially, and has been helping out with all the really complex statistical and mathematical analyses that you'll be seeing. And so with those brief introductions, I will be sharing my screen here, and we will jump right into the presentation. Please feel free to stop me at any point if there's any questions that you have, and we'll answer we'll answer those questions. And so, as Dan had mentioned, we essentially began our analysis or by looking at really a very broad universe of possible scenarios. But we narrowed those down to something that I think makes sense and is digestible. We looked at, or what we're presenting today, are 3 funding levels and 3 structuring options. The target CalPERS funding levels that we're looking at are 80, 90, and 100% funding. And we're looking at the 3 structures that Dan just mentioned, ascending, level, and hybrid. The analysis that was used in order to evaluate everything, we utilized what's called a Monte Carlo simulation, which is basically a random number generator that helped us evaluate 1,000 scenarios. Also, in the analysis, we're going to be looking at CalPERS projected returns throughout the life of the financing. All the scenarios that you're going to be looking at, they've all been optimized in order to maximize savings to the city. And what we're going to be doing at the end is that we're going to be taking the CalPERS Monte Carlo simulations and projections. We're going to be marrying that with the optimization, and we're going to be presenting an assessment of the risks of overfunding. And I know that that's something that this group was very concerned about. And so we wanted to make sure that we addressed all the issues. So with that, we're going to begin here. And this is really a summary of what the Monte Carlo simulations are and what they're doing to help us assess everything. So before I get into the I guess, meat of this and what it all means, I want to just talk about what essentially is behind it. What are some of the assumptions that we made? So the first thing is that we used the current asset allocation of CalPERS. We also assume that CalPERS will be rebalancing their portfolio in the future to account for disparity in the future earnings among the different asset classes. We also assume what's called reversion to mean and investment returns. And what that means is that in the long run, returns will essentially come back to their mean, their average. And also we included as a metric of volatility and risk in the portfolio standard deviation of 12. And so we have here on the left-hand side is really the result of one of our Monte Carlo simulation summaries. And it's essentially a graphical representation of 1,000 different simulations of what CalPERS would earn over the life of the financing. And what it's showing here is that CalPERS has a projected earnings over the life of the bond of about 6.6% based on this simulation. And you see there on the blue, that is what a 90% probability scenarios, what they would result in. And so we have a 90% probability that CalPERS will earn somewhere between 5.47% and 7.68% over the life of the financing. And so we use that really as kind of the benchmark what's behind some of the analysis that you see kind of in the back end of the presentation. And so the second part that we then focus on is the structuring of the actual POBs, or the structuring of the actual financing. And so, like I mentioned before, we had 3 structures with 3 different funding options. And so we have 9 options, and you see that in this table here on the left-hand side, there's 9 options. We generally break up the table by the funding options, the 3 funding options, so 100, 90, and 80%. You see the UAL payoff amount for each of the different options or structures. And then you have the individual structures that, again, Dan spoke about earlier, and each of them are the same for each funding level, so hybrid, level, and ascending. Towards the middle here, in the next column, we have the all-in PIC, which is really the borrowing cost of the transaction, including all costs of issuance. We have the savings figures based on 2 metrics, both present value savings and cash flow savings. And so what we show here is that on the 100% funding option, using the hybrid approach, which we'll go into some detail on what that exactly means, the cash flow savings throughout the life of the financing are about 103.6 million. Those amounts fall as we look at the different options with level and ascending within the 100% UAL funding level. And then we see a similar thing happen with the 90% option and the 80% option as well. And so I'm going to go to the next slide, and we're going to talk about big picture structures, and then we're going to get into some of the cash flow detail in the following slides as well.
Michael, can you hold for a second before you go to the next slide?
Absolutely.
Just so that and this slide is fine as well, just so that we all, we can't be afraid to ask questions, and someone else must be wondering. So if our unfunded liability is 211 million, and we're going to fund 100% of it, am I reading the first line correctly?
That is correct, yes.
So how is 90% of 200 million 155 million?
Because it's not 90% of the outstanding UAL, it's to achieve 90% funding. And so the UAL is basically an equation that is what the actuarial liability, which is basically how much money you need to have in CalPERS versus how much assets you have there. So that deficit, that difference is the UAL. So 90% of that deficit doesn't get you to 90% funding level. That's why.
Okay.
Okay. So for example, I guess a good way to do it is that, let's say, for example, you need $100, right? And you only have $50 in the bank, right? If you fund at 90%, the balance, right, is not going to get you at 90%.
Yeah, I don't see anybody getting that. We're going to need to delve into this. So I've got a $100 million pension liability, and I'm 90% funded. That means I've got 90 million in there, right? And so same thing. If I want to get to a 90% funding level, I think I need to pay off $180 million.
Yeah, let me take a stab at it. Let me take a stab at it. So basically, CalPERS looks at all of your liabilities, and they say the city of Redondo Beach owes, let's just say in round numbers, $100 million in unfunded liabilities, total liabilities. That's what you owe when they do all their models and project how long people are going to live, what their benefits are, et cetera. So you need $100 million. If you only had $80 million in investments, you're at an 80% funded status. You're basically at a 80% funding level. You're 200 million short. So to get you to 90% funded status, we need to add $10 million, because that would get us to $90 million. So what we're saying is that if we were to add $155 million to your assets, that would get you to 90% of your liabilities.
Totally get it. Yeah. Another way to look at it is, let's say it's $1 billion. If we're 80% funded now, it's 800 million. So what I'm looking at is the 200 million and thinking it's the entire obligation. It's the unfunded amount. So
correct.
Hopefully.
And Commissioner Johnson, that's an excellent point. And I think for the council presentation, we'll add the total liability column.
If you do, it'll help.
What would a 100% funding level look like, and what would a 90% funding level look like, in addition to the UAL?
Yep, I got it.
Commissioner Solomon?
Thank you, Chair Conroy. A couple of quick questions, please, Mike. What is the assumption for the bond duration that you're using? Are you using 30 years? Because I know that's been decided.
Yeah, no, so all of the scenarios that we're looking at match the current final maturity of the UAL. So it's at 2049. We wanted to be very responsible in the structuring and no extension of the final maturity.
And were some of the assumptions that are input for, and this might be off theme, we have a mixture of classic and PEPRA employees. So we were going to see a slight decline in our obligation in about 12 years out, or a small descent in our obligation about 12 years out. So using our future obligations based on our current assumptions, that's what you used all of our current assumptions for our obligation, yeah?
That is correct. So all of those different plans are all taken into account in the current UAL, in that number.
Okay, all right, thank you. Just wanted to clarify that for myself. Thank you.
You got it, no problem.
Great. Mike, I had a couple of questions for you as well. A while back, this might even be a question for Dan. A while back, we asked for a survey of recent similar city funding levels. I don't recall if we got that information. What are other cities in similar situations as us? What kind of level are they funding at?
Sure. So, for example, your sister cities. Manhattan Beach, they just completed their transaction about like a week and a half ago. They funded at 98%, and the reason in part was because they have a Section 115 trust money, and so the reason why they didn't go to 100% is because there's an additional funds that they have on hand to pay off some of those other UALs. The city of El Segundo, they funded also at, I believe, the transaction that they were targeting to complete this week. They funded up to 95%. Let me see here, we have a couple of other data points. So the city of Orange funded at 100%. The city of Chula Vista also funded at 100%. The vast majority of transactions that have taken place over the last 3 years, which is really the sample set that we've been looking at in this new form of pension financing, have done the 100%, but we can certainly get you the exact figures in the next week or so.
Okay, that's really helpful. I think probably coming in on average higher than what many of us were expecting. I know we had some discussion within our group about, with just kind of spitballing with more like a 90% number, but so that's very helpful.
The ones that have funded less than 100, they tend to be the cities that have had UALs in excess of $500 million. So, for example, the city of Torrance, their UAL was $500 million or nearly $500 million, and so they funded less than the entire amount.
Okay.
Chairman Conroy, can I ask a quick question that is right on this issue?
Certainly.
To help color our discussion. Mike or Dan, either one, what happens if we issue 100%, if we go for 100% funding, and CalPERS, by some ability, ends up earning more than their 6 or 7%? What happens if we're overfunded in the future?
Yeah, so what has happened in the past when cities are overfunded is that they'll make a payment holiday, essentially. And so in the past, they have told cities when that happens, when that has happened, because it's obviously doesn't happen often, that's why we're in this issue, that cities don't have to make their UAL payments. But, we have very rigorous data at the end of the presentation where we try to answer that specific question. That we can get into those details, and in fact, we've actually estimated the probability of that happening under the different funding options as well.
To directly answer your question, Commissioner Wortham, I believe that CalPERS has rescinded the ability to take payment holidays. Some argued that the payment holidays that were a result of the tech boom in the late 90s created many of the UALs. If cities had been paying their normal cost all along, because not only did they skip the UAL payments, they skipped the normal funding payments. And so instead of all along kind of paying for the groceries, that contributed to the early 2000s UAL crisis as well. But, as Mike said, they did a really good job, and we're about to see the analysis of the likelihood of that happening. So we can talk a little bit more about that in a few slides.
Yeah, exactly. So is that okay? Or would you like me to jump ahead and go to that part of the presentation, Commissioner?
I had another question as related to this, unless that helps you answer, Commissioner, the prior question that you received. Okay, let's just, if I could proceed, Michael, and then.
Sure.
Okay, so my previous assumption and what you basically just explained now supports that the major reason to fund less than 100% is hedging against CalPERS outperforming. Would that be it in layman's terms?
Yes.
Okay, so I would think, you mentioned that through your Monte Carlo simulation, you think that CalPERS is going to shift their investment asset classes in order to maintain something close to the mean. I would argue that they're more conservative than that, and as long as cities are funding the unaccrued portion, they have less incentive to take on more risk. So I think, if anything, it's going to probably skew towards the lower side of your return diagram, in my opinion. And plus, we know based on other recent presentations that the current estimation is that CalPERS next, when they move their target return level, it's going to be reduced, which is going to push our numbers up, which would then, I assume, shift all your green lines from the next slide up, if you want it.
So Commissioner Conroy, you are literally exactly, that's actually one of our closing points.
I'm sorry.
No, I love it. You're taking my thunder. Towards that, there's an expectation that in the next 12 to 18 months, there will be a reduction in the discount rate, which will then create a new UAL. So even if we fund at the 100%, you probably won't be funded at 100%. And in fact, we know already that come I think it's November when the new actuarial reports come out, that there will be a new UAL. So even if we fund at the 100%, you won't be at 100% pretty soon.
Just last week in the Sacramento Bee, there were two articles. One was in review of the budget. Governor Newsom considering putting $1.9 billion in the CalPERS. And the second article was CalPERS looking at California pension rate hikes to cities and workers. So that was 7 days ago in Sacramento.
So those deposits would be for the CalPERS portion of the state workers, the state employees, not really impacting cities.
But the second article was about CalPERS looking at just across the board increases to pensions.
Yes, absolutely. Yes. And so with that, I mean, should I continue here? Is there any other questions that you guys?
I'm sorry to be.
I want to add to that is I think the way the commission has been looking at this is a slightly different view, which is should we pay off 100% of the unfunded balance or 90 or 80% of the unfunded balance, which is an entirely different question than do we want to end up at a 90% funding level. So I think there's another scenario where maybe we end up at a 95% funding level, which is a much smaller haircut and don't pay off 100% of the liability.
Commissioner Johnson, we could have, run just countless iterations. We just kind of chose some benchmarks just to give you orders of magnitude so we can illustrate, a progression here. So this isn't necessarily suggested. Your choice isn't 90 or 100 and that's it. It certainly could be 95 or 93 or whatever the case may be, but this would be a really long presentation if it was, every other potential level. So it's just really supposed to get the conversation going here.
Wouldn't it also be fair to say,
we're supposed to make a recommendation by Monday?
Would it then also be fair to say if say we chose the 90% level and then the UAL goes up in the near term, then that 90% essentially becomes it shifts anyway. Yeah,
it comes down to like 88, 87.
Yeah, exactly. Which I would then say would be an argument to maybe go towards a higher percentage, knowing that in all likelihood, say like if we did 100%, it would be come down to like 97% in the year.
So on that note, not to get too much on the sidetrack here, I think we've mentioned this before. We worked with the city of Placentia, and Raul actually, his former firm, was the banker on that deal. And they actually funded more than 100%. They funded 100% of what was outstanding at the point in time, and they called up CalPERS and said, hey, you guys only got 4.7% return in 2020. Give us a preview of about what our additional UAL will be. And for them it was about another $2 million. And so they actually, with the lease revenue bond structure, which you can't do with the pension obligation bond structure, they paid off 100% of their then existing UAL, and they pre-funded or acquired funding and put it in a 115 trust with the intention of when they get their letter this August, they're going to go ahead and use the money they already have from the bond issue and then pay off that new UAL they expect coming. So if we go at this point in time and pay specifically 100% of what CalPERS says is owed, come August, you'll already be less than 100% funded.
Right.
That is correct.
And let me just, Commissioner Johnson, your numbers were spot on. I'm just kind of doing this in my head here, but 90% of your liability of 211 basically is about $190 million financing. $190 million financing gets you to exactly what you said, about a 95% funded ratio.
Yeah, I'm just pointing out, I think that's what we had in mind is a bit of a haircut and not to come up with a funding ratio of 80%. But I agree. I mean, in the same way, you know, this commission will never understand all of these scenarios as they're presented to us this evening. I mean, there's just too much data. So I agree that, you know, we're not going to look at everything. I just wanted to point out, I believe, and the other commissioners can weigh in, what we were suggesting is a haircut off the 211, not, you know, coming down to the 150. Even at 80%, it's $170 million, which we probably wouldn't go that low. But I agree we should proceed.
Commissioner
If
Solomon?
I could chime in on one item, talking about the overfunding. In a couple slides, we'll get to a list of all the assumption changes and whatnot that make up our UAL. And there are some negative amounts on there, and that's all that would happen is you would end up with a negative amount for 1 year, which then would be added to the positive amount for a following year. And you haven't wasted the money. You haven't just lost it.
And I think
Zero.
most
It does go in
probably
as
is,
negative.
and I hate to speak for everybody, but we probably understand that our unfunded liability is understated right now as soon as they recast their discount rates.
Commissioner Solomon, is there another question?
Yes, please. A couple quick ones for you. Educate me, please. The acronym TIC that you had there in the middle of the slide.
True interest cost. So the cost
Okay,
with
thank you.
yeah.
And then when we discussed a few minutes ago, Mr. Masiello was talking, and you had mentioned the Section 115 trust, and I appreciate bringing it back up again, something we had discussed. If we were going to explore having that available to us, would it be something that would factor into how would it factor into the numbers you're providing to us now? Is it just, is it something where it's siphoned off? Dan, how does that work with the numbers that are being presented?
Yeah, great question. They're kind of different conversations. The Section 115 trust it's like saying 401k. It's a designation by the IRS for how that investment vehicle is treated. You're a city, you don't pay taxes, but you'd be having an investment fund that was designed to have a return. But that, and we're focusing on the actual determination of how much to finance at this point in time. The discussion, it's funny, we were just talking about this the other day on our team call, the discussion of a pension policy, a management policy or city policy for managing pension expenses going forward could and probably should, we would suggest to include the consideration of setting up an investment vehicle, which is commonly called a Section 115 trust. And so, one option could be, as I was just pointing out before, something similar to what other cities have done, issuing a bond and maybe even over-issuing now because there's another UAL coming that is not included in these numbers, and you could fund that 115 trust. Or with the budget savings that are going to be created from this 115 trust. And sadly, we're not really talking about budget savings. We're talking about bringing or keeping the budget at a level that it's at right now. About $13 million is what we're aiming for. So we talk about savings because we know that the UAL will be this level. If you pay this level, that's a savings. But really, this year you're paying this level, and we want to keep it there going forward. So, but if the city feels that it has the ability and the wherewithal to start diverting or sequestering other city resources to basically save up to manage pension costs going forward, a 115 trust is one of the options available to do that.
Or for infrastructure. If that money would be put into a sinking fund, for lack of a better way of putting it, could you do it?
No, it has to be used for pension.
Okay, so the money that's paid out of the pension obligation bonds, and this is going to come up later when we talk about the budget, has to be used to pay for the pension and can't be used for other things like infrastructure or covering other items in the budget?
Well, we have a couple of things going on with that. One, we have securities laws. You're telling investors what the purpose of these bonds are, and so you'd want to make sure that you stay in compliance with that. But moreover, these are taxable bonds. We don't want to fund infrastructure with taxable bond proceeds. You want to do an infrastructure project, let's do tax exempt deal for less cost, for sure. So I think those are some considerations to keep in mind.
Okay. Thank you. That's really helpful. I'm sorry it informs a little bit later discussion.
Yeah, but if I could just chime in, a lot of cities have created pension funding policies in connection with POBs. It may or may not include a 115 trust, but in that policy, the council could do whatever they want. They could say, we're going to take 50% of savings and direct them to X. So if the council wanted to, they could have a policy that says, we're going to take X percent of savings from doing this refinancing and redirect them to an infrastructure reserve fund to provide seed money to get infrastructure projects going, or they could say we're going to redirect it to an OPEB funding or to a pension 115. I mean, they can do whatever they want. So, and they don't necessarily have to do it. Yeah, they don't have to do it when we do the bond deal, although most people do it simultaneously. They could do it after the fact. So.
Okay. And then the last thing, I just want to echo and agree with Commissioner Johnson, where we wanted to have some wiggle room there. We were talking about hedging our bets a little bit, and I agree with him. The consensus has been that we would not fund all of it, but some smaller amount to that. So I would, I don't want to mischaracterize what you said, Steve, but I would agree with that.
Not in the least, and if the commission, and by the way, it's just a recommendation, but if everybody feels that the unfunded liability is already underfunded, then 100% is already underfunded. But I appreciate your comment. I do think that's consistent with our discussions.
Thank you.
Let's revisit that question at the end of this presentation, because there's a lot of data coming to, maybe better inform that consideration.
So, here, let me, there we are. So again, just to, I think, provide a graphical, image of what we mean by the different structures, I think it's helpful as we explore what the different structuring options are. So when we say hybrid, what we mean is that we're creating level debt service through about 2041. And then the balance of the payments then very much mimic what the current UAL is. And the idea is, in order to avoid creating basically no negative savings, the level structure, as was discussed earlier, is just essentially flat, equal payments similar to your mortgage. And the ascending structure is essentially just that, creating a debt payment structure that increases over time. And the idea for that would be to maximize upfront cash flow savings. And so, again, those were the different structures that were laid out in the summary page beforehand, and that we are evaluating in the following pages as well.
And as we get into this, I'd just like to point out that, obviously we've been working with Marnie very closely on this, as well as Assistant City Manager Wodzansky. And Mr. Wodzansky had suggested that it's staff's opinion that they'd like to target a total payment level of about $13 million. And so as you can see in these graphs, and we'll see more directly in the next slide, these various options present different funding levels that either comply with that or don't make that mark. So keep that in mind as we go forward.
Exactly. Oh, sorry.
So the payments represent both principal and interest?
Yes, and actually we have very detailed summaries on what exactly all of them would be in the following pages.
And so Mike, just real quick, that 13 million looks kind of like it's the hybrid structure, which is, I'm still listening to everything you guys have to say, but that's kind of where I'm leaning right now. But my question was this: can we lean on our sister cities again that are a little ahead of us in this process? Is it all over the place, or are we seeing primarily that these cities are going with one of these structures in particular?
Sure. So the hybrid option is actually the one that's been the most popular, certainly for many cities. Although the city of Manhattan Beach did do the level debt service structure, in part, and again, we weren't involved in that transaction, but in part looking at the structure of their UAL, they have their shape of their UAL has a very slow ascending payments. And so the level debt service structure provides potentially different benefits to someone that has a slightly different UAL structure. And so just to, I think, so essentially what we're doing here is that we're running two models. One is the Monte Carlo simulations that help us project out what CalPERS would earn. And then the second model is where we try to maximize or make the most efficient POB repayment option. And so what you have here on the left-hand side, this table, I'm sure you guys have all seen it before, but it's essentially all of the individual UAL bases that comprise that overall $211 million UAL. And so it's a very dynamic process when we're doing the optimization for the individual structures. And so we begin first by taking each refinancing of each individual UAL base and then ranking them based on return, PV, and cash flow savings. Once we have those rankings, then generally the largest and the longest bases will kind of rank highest again because they're the largest and the longest and will generate the most savings. But then to optimize the process or to optimize the structure, we then replace some of those longer bases with shorter bases because the shorter bases will then allow us to put more principal in the front. And so it's a very dynamic process, and it's definitely impacted by the different funding levels and by the different structures that we would like to evaluate. And so, again, that's the pension optimization model, which is separate than the Monte Carlo simulations that we introduced in the beginning and that we'll bring together at the end of the presentation.
And just to point out, can you back up for a second there, Mike? And Maureen had mentioned this before. I just want to make sure it's clear to the commissioners that every time the CalPERS misses its mark or exceeds its mark, and every time that CalPERS has an assumption change, it creates a new base. And you can see some of these are actually negative, which means it was a positive in a sense. It's a credit in your account. And you can see the year in which each one was established. It's not just one lump sum that, oh, you owe this money, it's growing, it's contracting. They treat each as like an individual loan, if you will, and they amortize that investment loss or gain. They actually amortize the gains as well, as you can see, like for the right in the middle of the page there, for 2014, there's a $15 million gain in that year that's offset by the $9 million assumption change, but they're each amortized on their own parameters. Like the assumption change is being amortized over a 15-year period, but the investment gain is going to be amortized over a 25-year period. So, at the end of the day, what Ramirez did was apply, the analysis within that construct, within those kind of parameters. So this was no small task at all. This isn't just saying, oh, I owe $200 million. How should I repay? It's much more involved than that.
Exactly. Yes.
Michael, quick question on the Monte Carlo simulation. What value should we place on that, and how did you come up with return assumptions to use in the Monte Carlo simulation?
So, Al, are you still on the line? Would you like to give us a little bit of insight into some of the analyses or assumptions that were included in there?
Sure, and I'll do my best to keep it sort of down to earth. The very simple fact is in CalPERS they have various categories of investment, and we structured the simulation model to duplicate the volatility and the expected return of each of the categories. So, there's regular equity, there's private equity, there's fixed income, etc. And CalPERS provides expected returns and volatility for each of those categories. And we developed a simulation that lives up to those numbers that CalPERS says should be the benchmarks for each category and aggregate them together in terms of what we have for our projections of earnings.
So you're using their return assumptions. That was what.
That's right. That's right.
Okay.
And so in the next slide here, in the next 3 slides, what we did is that, and I think there's a lot of value in providing some of the details, so I think we can better understand the magnitude of some of the savings with the different structuring options. And so here, this is all 3 of these are 100% funding, and we show the ascending structure, the level structure, and the hybrid structure. Now, on the far left, we have the current amortization. Now, we see 2 columns for each structure, both the ones called bonds and then savings. The bonds, because in this scenario, we're funding 100% of the UAL, that's what the entire pension payment would be for the city, and then next to it would be the savings. So, for example, in the ascending structure, the bond payment would be $9 million, which would give the city savings of $6.1 million. In the level debt service, we have a bond payment of $11.6 million, savings of $3.8 million, and the hybrid option gives it's a bond payment of about $13 million, gives savings of about $2.4 million. All of these options can be slightly tweaked. So, for example, when we worked for the city of Pomona, they, at the time, it was in the middle of COVID, there were some concerns about budgeting, and so they decided that they wanted to defer principal 1 year to help them essentially close a budget gap, and so we did that. So again, all of this can be tweaked, but we wanted to show the 3 basic structures that we were evaluating in this option. On the bottom, again, you see what the payoff amounts are in that kind of bright blue, the all-in TAC, and then the present value of those savings that we're showing. And so, again, that hybrid option, I guess, Commissioner Conroy, you were 100% right that it's hitting that $13 million number very closely. And again, any of these can be adjusted as needed. In the following slide here, we showed the 90% target funding option, again, with the 3 different structures, ascending, level, and hybrid. And just going all the way to the right here, comparing kind of apples to apples from the prior slide, the hybrid option in fiscal year 22 would provide a $14 million total pension payment. That would be the bonds plus the remaining UAL, and generate savings of about $935,000. The level option that creates a pension payment of about $12.8 million, pretty close to what the city would like, with savings of 2.6. The issue here in this level option is when you come back, in the kind of later half of the transaction, down in like 2042, you see all those negative numbers. So we call that negative savings. So the total savings, when you go all the way down to the bottom, that $44 million, that's significantly lower than the hybrid option, and very much significantly lower than the prior page as well. We did a similar exercise for the 80% funding option, and we show again the same structures that you all have seen in the prior 2 slides: ascending, level, and the hybrid options. The 80% fundings, and once you start getting in the lower kind of funding levels, the structuring of them becomes a little bit more challenging, and the reason for that is because you think about like a mountain that you currently have as your UAL payments. In the structuring, we're essentially shaving off parts of that mountain and restructuring. And so if you're shaving off less part of those mountains to create the optimal structure you're looking for, it's a little bit more challenging. And so that's where I was talking about earlier, how there's an entire optimization process where we evaluate the different individual UAL bases. And Commissioner Solomon, I think there's a question.
Yes, thanks, Mike. Since you put this together at the Monte Carlo and you had all these different assumptions, does it factor in that CapEx risk of CalPERS underperforming in any given year and coming back to us and saying we need an extra $2 million or an extra $1 million because we've underperformed in this year? Does the analysis include that risk?
So that would be an actuarial kind of analysis that we didn't focus on in this instance. Our focus really would focus on the savings and focus on the projected funding levels, which we show on the next slide, actually. And so on the next slide here, what we do is that we bring together the two models. We bring together the optimization model and we bring it together with the Monte Carlo simulations to get a sense of what the funding level would be at the final maturity of the bonds. And so what we show here on the left-hand side and on the right-hand graph there is what is the average result of funding 100% of the miscellaneous and 100% of the safety over the life of the bond. And what we show here is that if we fund 100% of the UAL today, the average result that we see with 1,000 simulations is that the funding level at maturity for the miscellaneous plan would be about 70.3%, and for the safety plan would be 67.3%. And so because the Monte Carlo simulation projects an average annual return of 6.6% that we showed in the very first slide, there's a probability that CalPERS a significant probability that CalPERS outperforms the city's bond rate without overfunding when you look at the life of the transaction. What we did in the next page, and again, I'm just going to go here because I think there's going to be a lot of these questions that are going to be sort of related. But if we go to the next page, what we did is that we looked at not only what the final funding number looks like, but what the probability of overfunding prior to final maturity, right? Because you could be overfunded a couple of years, but then there's some losses. And so those funding levels will fluctuate through the life of the financing. What we show here on the left-hand side is the probability of an instance of overfunding, which we define as being 5 consecutive years of having a funding level at 115 or higher. What is the probability of overfunding with a 90% scenario and with a 100% scenario? And what we show here is that there's about a 2% probability of overfunding with the 90% funding option, and there's about a 14% probability of overfunding with the 100% option. And this is not at the end, but an instance of overfunding throughout the life of the bond. And so we had some observations here at the end where we kind of brought all of the analysis and we spent a lot of time on our end. Commissioner Conroy?
Do you have a similar analysis that shows what the percentages of being overfunded at the maturity at the end of the?
This is what it is. This is what this is that analysis.
Oh, the prior slide.
So the prior slide here. So this shows the average funding levels of 1,000 simulations if we fund at 100%. Now, each one of those bars is essentially a funding level of one scenario, and all of them combined, the average scenario shows 70.3% for the miscellaneous and 67.3% for the safety.
So pretty far away from overfunding. So very, very high chance that we would be overfunded at the maturity date.
Yeah.
Yeah. Even at 100%.
Yeah. Okay. And again, we assume no changes to the discount rate. We assume no changes to the expectancy of life assumptions. Literally status quo as CalPERS is today. And so we spent a lot of time going back and forth with Marnie, with KTS, and definitely internally, both with Al and his quant team and me focusing on all the pension analysis. And so we really came together with, I think, some observations that I think were kind of important, because I know that there's just a tremendous amount of data here. The first observation on structure is that we believe that the hybrid structure maximizes savings while generating no negative savings, which I think is an important point, especially when you're doing pension type financings. And it also provides the upfront cash flow relief that I think the city is looking for. As far as the funding levels, the 100% target, we show that the CalPERS projected annual average return is about 6.6% based on our very rigorous analysis using the data that CalPERS themselves give us. And so there's a good probability that that CalPERS will be overperforming the bond rate, which again is in the low 3% that we're looking at for some of these options. The again funding level gives the savings that the city is looking for about $2.5 million, which we use like pretty conservative numbers, but we can also adjust as needed. And we also know that CalPERS will be generating a new UAL in the next couple of months. By the end of the year, you will have a new UAL. We also looked at some of the reporting of CalPERS themselves, of what is the sensitivity of some of the changes in the discount rate. So a change of 6% in the discount rate creates a new UAL of about $77.1 million. Now, there's really no way that they would drop to 1% immediately. But again, just in the order of magnitude, a 25 basis point reduction, so a reduction to 6.75% is somewhere in the ballpark of about, I think I calculated it as being here about 20 million. And also, finally, we do know that at this point in time, interest rates are just at absolute low levels with all the support from the Fed. And so, again, in part, that is why there is a push for, I think, the lease revenue option, because it gives a certainty of entering the market right now while interest rates are still low versus waiting 6 months in the second half of the year where we don't know where interest rates will be moving. And so, again, I know that I kind of paused through these last couple of slides, but there's just a tremendous amount of data, and I kind of wanted to give you guys a little bit of sense how we put all of it together, but definitely open to any questions.
Michael, a quick one. Suppose CalPERS reads the tea leaves as you do, and they reduce their actuarial assumption to 6.6%. The effect on Redondo Beach is what? An immediate increase in UAL.
That is correct. And so you will have new UAL payments.
And should we be looking at, we know they're going to reduce it somewhat. We know that there's an increased UAL coming from this year, from FY 2021. So should we be looking at increasing the amount of funding to take both of those into consideration? We know they're both going to happen. We just don't know how much they're going to reduce the actuarial assumption by.
Yeah, so we, from our end, we didn't take the actuarial approach just because we're not actuaries. What we did is we're experts in looking at the CalPERS optimization based on what is happening today, and again, being able to project what CalPERS could potentially earn, based on very rigorous kind of data that they provide. And so that's really what we focused on. Definitely, Dan, if you'd like us to look at those options, we can certainly do so.
Yeah, Jerry, I mean, I'm sorry, let me just chime in here for a second, but so in fiscal year 20, CalPERS rate of return was 4.7 because of COVID. So their actual reports lag. So the report that the city will get in July of 2021 will reflect that loss, right? They didn't earn 7%, they earned 470. You're going to have a new actuarial liability in this report that you guys will get. I think you guys get them right around October, if I'm not mistaken.
Usually August.
August, okay. We know as we sit here today, 30 days away from the end of fiscal year 21, that we assume they're really going to outperform. So a year from now, in the fall of 2022, you're going to have an overfunded asset base that's going to offset the one you're getting this year. As Jerry said, I mean, I think everyone who follows CalPERS knows they're going to reduce the actuarial rate. They kind of have to. Like, we ran the Monte Carlo simulation using their rates of return and their standard deviation on those rates of return, and guess what we got? 660. So they have the same model. They can do the same analysis. I think the expectation is that they're going to go probably to 675 in 1 or 2 steps. In the very foreseeable future, you're going to have a new unfunded liability because of that. So that's what we know. So in summary, all we know is that every year, CalPERS is either going to have an up or down performance, change in assumptions, and your funded ratio is going to fluctuate. But as we sit here,
and we're only addressing the UAL as part of this equation. When CalPERS reduces their discount rate, that means the normal cost will go up as well, because the normal cost bakes in an assumed return. And so if they're going to expect you or expect that they will earn less, then you need to put more current funding in. So you'll not only have a new UAL with an amortization, but in an overall holistic budgetary perspective, you'll also have higher current normal employee overhead costs for pension contributions as well, once that discount rate is lower.
Absolutely.
Commissioner Conroy Solomon.
Commissioner Solomon had his hand first.
Thank you, Chair Conroy. Yeah, I don't think there's any question that CalPERS is going to double down on going heavier into equity. They've already talked about doing that in order to try and chase returns. And this year is going to be a pretty good year for equity, but using your modeling, obviously it models out pretty well. We've talked a lot about the difference here between the approach that you used and the actuarial approach. What happened we asked about that's a big difference in considering the funding between an actuarial approach and the approach that's being used here? What I mean to say is that is there some whole something that we're not asking about the analysis that's been used that would look or reflect very differently using an actuarial approach?
Well, I think what's meant by the actuarial approach is the approach to the liability, what is owed to the membership pool. So that has to account for life expectancy, employee census, all sorts of variables that an actuary may look at. This is kind of more of a financial consideration that looked at applying a lower interest rate to a debt to be repaid in various ways, in concert with how would that financing of this deposit to CalPERS, because that's what we're talking about doing. We're talking about going and getting money at one interest rate and giving it to CalPERS to invest. And so we do it at one rate, and we can do that analysis in terms of savings and structure, and then we take that money and give it to CalPERS, and then the other side of this scenario is the Monte Carlo simulation. How does that money perform over time? What is not present in this analysis would be the manipulation of the number of employees at what point in time, who's Pepper and who's not, by the way. And as your employee census changes and you start kind of seeing that change from the classic to the Pepper, that's also going to limit the UAL changes because of the nature of how the Pepper system works. It won't be as impactful when there are changes. There's a contribution aspect from the employees as well. So I think that's what's meant, and I don't mean to speak for the Ramirez team.
So a good example is, and I'm just going to swing by go through a couple of slides here just to show you what I'm talking about. So again, slide 5, this kind of shows the current, all of the UALs that the city has outstanding. So you see the safety portion, the second half of that table. The first row says fresh start 30-year amortization, and then the second row says assumption change. That was an assumption change, and again, we don't know because we're not actuaries whether it might have been a mortality assumption change or what it would have been different healthcare costs or any other issues. Those kind of assumption changes we don't model out because we're not actuaries, and that's I think the type of things that we didn't look at. We looked at what the current CalPERS plan looks like today.
I guess what I'm asking in an inartful way, or trying to get to the point of it in an inartful way, is it's been touched on a little bit earlier, is that we're going to be underfunded even if we try and fund it 100%. And that's a factor of what the actuarial future of that number is. And it's based on a lot of the things that we're touching on here. So when we're trying to establish what number we should come up with or recommend or suggest, however you want to frame it, of funding that UAL, when you look at it as an actuary, there are these assumption changes that are happening underneath our feet on a daily basis. People living longer, people collecting pensions longer, a change from classic to PEPRA, all these different factors that come into it. And so you just answered the question, I think, in that that's reflected in your analysis with an assumption change. You didn't break down the assumption changes, but that's how you're, to me anyway, it seems like you're accounting for. Okay.
Well, we are not doing an actuarial run, so we are not assuming. Yeah, we're not assuming any changes in the CalPERS assumptions or et cetera, et cetera. We're not. That's how we're doing.
The analysis was their assumptions. Yeah.
Yeah.
Okay.
Yeah.
Thank you.
All right, gentlemen. So just observation and a question here. So I think at first glance, it may feel more conservative to want to fund it at a lower percentage than 100, because then, you know, we're not committing everything to this approach. But based on your analysis, what I'm getting out of this is that I believe it's more conservative to fund closer to 100%, because then we're locking in 100% of our current UAL. And based on your analysis, by the end of the maturity, we're at 70%. So just rough line average over the term of the life of this bond issuance could be at 85%, you know, just 170 percent funded, which still leaves, you know, the other 15% that's due to the volatility from CalPERS. So so it looks like to me like the 100% is the more conservative approach. But if you gentlemen can tell me that I'm way off, then I'm all ears. And then just in addition to that, out of the three approaches, it looks to me like the hybrid approach is also the most conservative because it provides the most in present value savings. And I like the fact that there really isn't any negative savings in it at all by design. So we can kind of have our cake and eat it too, in that we're getting a level spend here for a number of years, and it also decreases as the UAL, or the current UAL line is expected to decrease. So I guess my question is, do you agree with my assumptions there?
We agree with the hybrid, as Mike explained it and you just summarized it. So that's why most people do it, for the reasons you just stated. On the funding level, on the funding level, you know, it's really your call, because like I said, we know we're going to get an unfunded liability this year, but you can have an overfunding next year amortization based, because we know CalPERS is going to be 7% this fiscal year. So we assume there'll be another unfunded liability coming when they lower their actuarial rate. Like I think City of LA, City of San Diego and others have already reduced their actuarial rate below 7%. So clearly that's where the trajectory is going, and everything they say leads us to believe that's where they're headed. But, you know, what is the right funding ratio? I mean, really that's really your call.
Certainly. But would you say it's more conservative to lock in 100% of the current UAL, or is it more conservative to lock in less?
The performance will depend on whether CalPERS can beat the bond rate, right? Because you're basically borrowing money at 3%, giving it to CalPERS, and you hope to be 3%. If they can't be 3%, it's gonna eat away against your savings that we're projecting. But the way I like to think about it is, if CalPERS can't have a 3% rate of return, like something's wrong.
Got bigger problems.
25
Yeah.
years.
Something is wrong, right? We know
On
they
your
can't.
on your model, what's the percent chance that they can't be 3%? It looks like it's not even on here.
So where I was going with that is to say, not only is what is the rate of return over the life of the bonds important, but how do they perform in the early years versus the later years?
Sure.
Right, the timing of the performance, and that's something that we are not analyzing here. But clearly, if they had a couple of robust years early on, I mean, now you've got money in the bank. They could underperform, and it'll be easy. If they underperform early on, now you're basically in a hole that you got to dig your way out, and it's gonna take longer to recover if the underperformance happens in the early years versus in the later years. But how do you analyze that? I mean, it would be Monte Carlo simulations, endless, trying to figure out, okay, what are they going to earn in year 1, 2, 3, 4, 5, all the way out to 20 some years? So I think that most people, the way most people look at it is, do I think CalPERS can beat the bond rate? And if they can, the savings that Mike is showing should be achieved by the city. That's how most people look at it. But they also know that there's going to be fluctuations.
And I think adding on to that, the Ramirez folks and I are in different positions, right? And the Ramirez are bankers working with the city. Of course, they have their best interests in mind, but our role as a municipal advisor is to be your fiduciary. So my personal and based on professional experience, opinion in this matter is we're talking about public funds here. The city owes CalPERS $212 million. CalPERS is charging the city 7% interest on that loan, on that deficit, whatever you want to call it, that liability. What is the likelihood of CalPERS outperforming the 3% over the next 28 years that we're talking about? Of course, past performance is no indicator or guarantee of future returns. We all know this. But, if CalPERS can't beat 3% over the next 28 years, cancel your plan and join something else. It seems highly unlikely that over the long haul that would happen. So to me, the analysis is somewhat straightforward. Should we take our public money for our employees that they've earned, and solidify it, shore it up, and repay this deficit at a lower rate of interest, or should we hope that CalPERS out-earns what they've been doing to erase this deficit and therefore no longer be able to charge you 7%? It seems to me hard to argue against funding, and it's an emotional conversation, and it's a policy choice, and it's based on what the constituents of your city believe, and sometimes that doesn't always mean that math applies, right? But from my seat where I'm sitting, that's the analysis, in my opinion, is the lowest cost of funding to repay this deficit. That was no choice of the cities. The city didn't go blow this money, now you got to make it up. It's this was imposed on you, and so is a high rate of interest. And it seems to me that the 3% to put as much of this loan on a lower interest rate as possible would be a very prudent choice. That's not to discount the opinion or to say that this is the wrong analysis, because it absolutely could be the case that CalPERS, they're going to have a good year. And the year we're in right now, in 2021, last I heard, the return was somewhere in the 12% range. I have to double check that. So they're having a very good year this year. But that's 5 points, almost 6 points over what their projected rate is, versus, being below it by 3.5 points last year. What is the size of that benefit going to be? The opposite of a UAL, and will that counteract the effects of what the 2020 UAL will be? Stay tuned, and within that time period, will CalPERS make adjustment changes that offset that too? You go look in all those bases that are in there. How many years show investment gains immediately offset by an assumption change? And it's as if those gains didn't even happen. So, there is definitely a not random, but an unavailable piece of analysis that we can't tell what our actuaries are going to do. So, from my municipal advisor kind of perspective, the city owes $212 million and you're being charged 7%, and you can refinance that in the low 3% range. That's kind of where I come from. But it's not my choice, of course. We want to give you all the data we can to help you make that choice. What was very compelling to me in this analysis, if you can go to that next slide, I think it is, Mike. No, keep going forward. The probability of the overfunding, because I've heard that discussion for years. Discussing whether or not to go for the funding at all. The two sides. We give CalPERS a bunch of money and they blow. We give CalPERS a bunch of money and then we didn't need to. I thought it was very compelling. Even the next slide actually is what I'm talking about. The instance of overfunding for a period of 5 consecutive years being at a 115% level, which, I don't think any of the city's employees are going to mind if their pensions are more than 100% accounted for and funded. Of course, that's not the only driving decision point here, but the fact that it's such a low probability in this simulation really opened my eyes. I hadn't seen a run like this before. I thought it was a very compelling discussion. That's actually lower risk than maybe is emotionally, than it feels like.
And just to be clear, Dan, I mean, this is a scenario where we're calculating, will CalPERS result, will their performance result in an overfunding to the tune of 115% for 5 consecutive years?
Mm-hmm.
Obviously, if you change that to 3 years, the probability is going to go up. If you change it to 2 years, the probability is going to go up. So this is just like, perpetual, long-term overfunding that becomes an issue for the city, right? The unions saying, give us a raise, or the council saying, let's spend all this money. So that's really why people sometimes say, I don't want to be overfunded because of those reasons. So the definition of overfunding for these probabilities is what's on that paper, right? They're 115% for 5 years.
Commissioner Solomon?
So I'm, so for the other commissioners, as far as where I stand on it or my feeling about it is, I would agree with the analysis from Ramirez, and that seems to be what's coming out here about the hybrid model. And maybe we can come to a consensus on that or hear everyone out on that. When it comes to the funding, even at 100%, we would be overfunding. I would still want to or think about funding for less than 100%, just as a hedge over that unknown, the series of unknown unknowns or black swan events or however you want to refer to them, to consider that level of buffer of those things happening, perfect storms, however you want to refer to them, in looking at this and funding certainly over the 90%, but somewhere between the 90 and 100% is where I would land on it as far as what we're funding. We are recently giving all of our employee unions raises. We're locked in to those raises over the course of the next 3 or 4 years. It's only happened once in my recollection, back in the 2009 or 2010, where our unions took pay cuts. We also do have our turnover where we're going more towards PEPRA rather than classic employees. So we've got that factor coming into it to help us in the danger of underfunding this. So I would be less than 100%, but comfortable with the hybrid model.
Thank you. It looks as though the Ramirez presentation is concluded, so I'm going to ask commissioners.
Yeah, let me just kind of wrap that up there.
Sure, Dan.
Chair, I have just a few more slides on mine, and then we'll just, to kind of help conclude this discussion. I know you have more topics to discuss, so let me go ahead and share my screen again. So we saw this slide. So after all that, hold on, let's see, where are we? As was noted, so the high points are, we want to talk about recommended approach, the lease revenue bond versus the pension obligation bond. And obviously the funding levels in terms of sizing, and then the repayment structure, input. And we'd like to help you with that discussion as much as we can. But just, this was asked about before, what would the next steps be? So, obviously tonight the commission is being asked to provide input and guidance on the topics we discussed tonight. We will address that with the city council next Tuesday and discuss what the commission recommended. And we'll run through pretty much a similar presentation with them with some of your thoughts and direction added in. And if we are proceeding with the lease revenue bonds, the current anticipated schedule is around June 11th. We will actually have a credit presentation to Standard & Poor's to describe the structure that we're employing and going to market with. Then we will come back to the council for the actual action on the bonds, which would include approving the authorizing resolutions, authorizing the documents, approving the official statement. And then the current schedule is to price the bonds on the 1st of July, with the closing to occur about 2 weeks after that, at which point is when we will make the payment to CalPERS and pay down the UAL. If the lease revenue bond is not the path that the city chooses to be on, then the pension obligation bond route would result in the June 15th meeting likely would be where the validation proceedings would be approved. That, you know, there would be an approval of a bond issue authorization, but it'd be kind of like a light approval, just the base documents that we would need to send to the court, with the kind of part 2 of that approval process to happen sometime after the validation concludes, which would be, I'm just calling it mid-fall. Because, you know, what is the court schedule going to be? It's, you know, we can't tell. It's at least, there's no way, like, statutorily for it to be less than 3 months, but it's more likely 4 to 5. And then, you know, somewhere around the 4th month or so is when we would kind of start the bond process again, have a little bit of dual tracking, but it would be probably 5 to 6 months from now, which would be November, before we would be able to conclude the bond issue on the pension obligation bond route. So thank you for your time, and thank you for your thoughtful questions and commentary. And I hope that we've helped shed some light or help make your decision process a little bit, you know, more informed. I don't know if it's easier, but you know, I certainly hope we didn't confuse anybody. I know this is pretty heady stuff, and there's a lot to digest and absorb. And I certainly applaud this commission for its thoughtfulness and thoroughness in this whole process. Very impressive how engaged everybody's been, and I just want to offer my, you know, congratulations, I guess, if that doesn't sound condescending, because it's not intended to be. But I certainly appreciate working with you all. And thank you very much.
Thank you. I see Commissioner Woodham's finger is up.
Yeah, a question for Dan and a comment.
Sir.
The comment is, I apologize for not being able to opine on whether we do 100% funding or not. A moment ago, 30 minutes ago, when I asked the question of what happens if we're overfunded, immediately at that point, electricity went off here on Avenue A. So I lost my Wi-Fi connection and I lost that answer. So I'll catch up with that later. But Dan, a question that I'd like you to answer before we go into the budget discussion for this commission later on. One of the pieces of the budget has to do with repaying the city for part of their contributions to CalPERS. I may be misinterpreting that budget comment, and I can be corrected later. But as I understand it, we cannot do that from this bond issue. Is that correct?
So at one point in time during this process, Commissioner Woodham, we were trying to kind of handicap when we'd be where we are tonight. And the discussion came up that if you did a lease revenue bond, and let's say it was more like, you know, right now we're in July or August, and the city was faced with a decision: do we prepay the entirety of the fiscal year 22 UAL amortization payment and capture that 3% discount, or do we, if we do that, if the city did that and then issues lease revenue bonds, the city would be allowed and able to reimburse that payment to the extent it felt it was reasonable out of bond proceeds. If it's a pension obligation bond, once that payment is made, there's no longer the debt associated with it, so it would just be gone forever, because we have to ask the court for a very specific authorization to pay off the debt as it exists at the point in time we commence the transaction. Is that what you were talking about? That
Yes, yes.
So Dan, are you saying the city would be free to spend that $2.5 million however they saw fit, including just for operating expenses, general fund expenses?
No, what I'm saying is that at this point in time, here at May 27th, we're projecting that we'll be able to conclude the process. There would be a need to add additional proceeds or from the proceeds reimburse the city for expenses it has incurred. Now, legally speaking, and I'm not your bond counsel, but so the answer to the question you was asking, Chair Conroy, is no. I mean, we have to tell the bond market what the use of the proceeds are for. Now, if the city determines that, you know what, we want to use some of this for working capital, we want to plug our budget with some borrowed money, You legally may. These are federally taxable bonds. We'd have to make sure under California law the purpose for which you'd be intending to borrow would be authorized. I'm not so sure there'd be a specific reason for that to happen. There's no structural deficit that I'm aware of, for example, that would kind of encourage that or make that okay. But there would also be a big red flag for the credit agency as well. I mean, I don't know that I would advise to do that, considering the condition I know that the city is in. So that's kind of the short answer. Does that answer your question?
Yeah, it looks like we were going to make a $15 million payment. And then when the UAL was satisfied with the bond issue, we were thinking there would be some monies that came back to the city from CalPERS, unused funds. And then they were trying to appropriate those funds towards one-time general fund appropriations. And maybe the theory was that the money that got paid to CalPERS was out of the general fund. And so money that came back would be general fund monies and able to be used. But it occurs to me we're paying it off with lease revenue bond funding. It's revenue, they're revenue bonds, and I don't know how you could use that for general fund expenditure.
Well, what would happen here is that, yes, the scheduled fiscal year 22 payment is about $15 million, right?
Right.
We're going to make it so that
it'll be 13.
We're going to replace that with the bond payment. So to the extent that $15 million is paid, so yeah, maybe that is actually the mechanics of it if you think about it. So we're going to make the $15 million payment with bond proceeds, right? But then the bond payment that comes due in fiscal year 22, just instead of the beginning, it'll be in May, will be $13 million. So 15 minus 13, I'm being round numbers, of course, is $2 million that is now available for you in your budget that wouldn't have had to be spent. So it doesn't come back from CalPERS exactly, but it's transferring, instead of paying the UAL out of the budget, you're going to pay a bond payment out of the budget. The UAL will be paid with bond proceeds, including the upcoming 22 scheduled bill payment. And we'll pay that a little early and get the 3% discount because it'll be paid before the end of July.
And since that money would have come out of general fund, then it's not part of the bond payment. I'm inferring from that they're not considering it bond proceeds and therefore usable for other general fund purposes.
Yeah.
Is that how you theorize it, Marnie? You're shaking your head?
Yeah. Yeah. So the slide that Mike had where it showed the savings year by year. So the 21-22 year, the 100% hybrid had 2.45 million, I think, as savings. That savings can be used to balance the budget.
So if this decision is the recommendation to the council, and the council makes a decision to fund for less than 100%, that figure would not be $2.5 million. It would be some amount less than that.
Yes.
Correct.
Okay. So that $2 million for later discussion is a little bit more of a fungible number based on the decision that's made by council for the level of funding here.
Yep.
Okay, thank you.
And Dan, one additional point. So we know that the CalPERS rate's gonna be coming down here pretty soon, meaning in the next year, there's going to be a new additional UAL that's obviously not paid for through this bond issuance. So we're still going to have increasing over time for the foreseeable future UAL payments. So I can see how potentially there's a pop this year for this year's budget and with some of these one-time appropriations, but certainly these pension payments are going to continue to increase and be a large and ever-growing percentage of our budget. So
yeah, it's really hard to handicap what will that UAL be. Looking back at I'm just looking at this slide that Mike had. with all the bases. You had some years where UAL was created was $24 million in one of the funds. It's like, but that was a particularly appalling return year when CalPERS was really taking the pants on its real estate assets. I don't think the 4.7 missing the 7% mark is going to equate to that, but a couple of $1 million probably. But then that's amortized, and so how much will your budget go up? That's a 20-year amortization of $2 million. Cowboy math, that's $200,000 a year or $400,000 a year. That's not going to make or break your whole fiscal year. So it's not.
My point is the bogey there, the difference between what our current payments are and what they will be under the bond issue. There should be no assumption that difference just automatically we're going to have as additional funds.
That's right. Thank you for pointing that out. And I do like to get in once in a while. And I think I might have said it to this group before. The word savings is hard to avoid. I mean, you are going to owe what CalPERS says you owe. And if you pay something less than what you owe, that's a savings. But we're really talking about a reduction in expense increases. Those increases won't be realized. You won't have to find the resources to pay them out of the budget. However, this year, fiscal 2020-2021, the payment was about $13 million, I think. And Marnie can correct me if I'm wrong. So if we keep that payment in the budget at $13 million, that's not a savings, but it's not an increase either. So, we're attempting to reduce those increases so the city does not have to pay for them, which some people call a savings, and it's common to call it a savings, but you're correct. There won't be an actual amount of cash, which is why I do caution other cities the same thing. They say, we're going to have all these savings. Let's set up a 115 trust. Let's put half of it away. Well, you would have to budget an increase to put that money somewhere because that money's not coming to you. It's just not going to be paid. It's not going to have to be expended.
Or worse than save it, spend it all right away.
Or that it's not there, right? It's just not going to have to be paid, but it doesn't mean that you're going to have a savings like a true refinancing would be.
Thank you.
And to go to the negative UAL that may come in the future, so you're going to have, right now it's projected, for example, in 23. A $17 million UAL payment. Well, if things go bad, it's going to be higher than 17. It's going to be 19.
Right.
So you're either going to pay it separately or you're going to pay it just as a bigger UAL payment.
Exactly.
But you got to pay it.
Yeah.
All
There's
right.
no getting around that.
Getting around it.
Do we have more questions for our panel? Okay. All right. Seeing none, are there any public comments?
There's no e-comments.
You're muted, Marnie.
I don't see any hands raised from the attendees.
All right, then, gentlemen, I'm going to thank you for your presentation. I think it was extremely well put together and informative. And at this time, I will ask for a motion to receive and file item J1.
Are we do we make a recommendation here, Marnie, or?
Yes,
Okay.
that's what we would like.
Oh, okay. I'm got ahead of myself. Marnie, is this something where we would keep the panel with us, or would we excuse them and then continue our discussions amongst ourselves?
Karen, I'm going to jump in there. If it's okay with you, I'd like to stay on because we have to get ready for the council meeting right away, turn around what you decide here and kind of start incorporating it into our efforts.
I think we can certainly let Al go. It's
Mr. Quintero.
Yeah, we can let Al go.
Yeah.
That would be fantastic. He's out on the East Coast.
Thank you, Mr. Quintero.
All right. Thanks a lot, Al.
Take care. Thank you.
okay. With that, we will close our panel presentation and keep them here and continue with our discussion within the commission. I think I've spoken a little bit. I think you kind of know where my head's at. I think you kind of know where Gene's head's at, Commissioner Solomon. We'll probably have some more to say, but I'd like to hear from anybody else on the commission some thoughts. Yes, Commissioner Woodham.
Could I get a 1 minute explanation of what happens if we're overfunded? That was a key question I wanted to ask, and the damn phone went out just.
Yeah, nothing. CalPERS holds on to your money.
But is there a holiday coming later? I mean, if we're 110% funded.
No. As of right now, no. There used to be back 20 plus years ago, and they eliminated that in the early 2000s after the .com bubble burst. They had granted not only was it UAL holidays, there was just, people were overfunded, so they were granting entire pension holidays, and then that ended up kind of, the returns went the other way quickly. So CalPERS eliminated that policy. Now, would they reinstitute it if everybody was overfunded, if the whole plan was overfunded? I don't know. But as of right now, my understanding is that the money just stays there, and you are at 110, 115% level, whatever that may be. Now, I would think that if it was consistently extremely high, there would be a strong case for, and I don't know if there's a process to kind of, and maybe Marty can tell us, is there a process to contact CalPERS and say, hey, we need an adjustment of our payment here, and here's why, in the city's case. But no, as of right now, that money stays in the fund. It's just like having more money in the bank than you need. It's like overpaying your credit card bill, and they won't send you a check.
Yeah, we don't
But
have
as you
interest on the
spend in
overpay.
the next month, you have that credit to
It's
use.
the buffer against future losses. Right, exactly.
Based on the math I saw, though, the chance of overfunding is much smaller than the chance of our UAL increasing over time.
Based on the Monte Carlo simulation, that's right. That's what the results showed.
Commissioner Marin?
Yeah, I think I align with you, Chairman Conrad. I think, with the low cost of capital and the high probability that CalPERS is going to be resetting the rate, we're going to be almost day one underfunded, and the low probability of them outperforming over the life of that bond. I think I would agree with that.
Okay.
I'm sorry, I didn't hear you, Damien. Could you repeat that?
Oh, sorry, I don't know if my headphones are working great.
I didn't hear Damien.
Is that better or no?
That's
Yes,
much
thank
better.
you.
Okay, sorry about that. I just would think with the low cost of capital, the borrowing costs are so low right now. So the high probability that CalPERS is going to reset the rate, and we're going to almost day one be underfunded, and a low likelihood of them outperforming over the duration. I think the 100% funding, I align with Chairman Conrad, that I think going the 100% route is probably the right way to go, along with the hybrid model. That'd be my opinion or recommendation.
Commissioner Woodham?
Yeah, my inclination is the same. I understand the risk of being overfunded, but I think 100% funding with a hybrid approach would be what I would favor, or certainly in 95% plus. I wouldn't go any lower than that. I'd want to get as much in savings as we can. So high 90s or 100 would be my preference.
Commissioner Wynn?
I was going to push the raise hand button, but if Jared can raise his hand and works, I'm going to do the same thing. After hearing everything, I kind of look at it as like, what would I do with my home mortgage? We own the money anyways, so what's the best way to save money, right? So I think I'm in agreement after kind of digesting everything. That was a lot. Hybrid, we save the most money. I think that's what's best for our city, especially heading into the budget. A little on the fence, percentage-wise. The conservative guy in me is kind of like, oh, maybe we shouldn't go 400, but maybe 95. So I think I'm in between there. Whatever the commission feels, 95 to 100, I'm there.
Thank you. I don't know if I'm missing any raised hands. If anyone wants to just speak up, they're certainly entitled to.
Mr. Chair, if I may just ask, is there any of the commissioners that think the city should file a validation and issue a pension obligation bond versus proceeding on the lease revenue bond course?
No, I think the lease revenue bond's for me.
I agree with the lease revenue bond as my recommendation.
Thank you.
Dan, do you have any idea, or the gentleman from Ramirez, in all their number crunching? Maybe we should have kept Al around. An estimate, an assumption of what we think our UAL will be. You mentioned, I think Placentia looked at what they spoke to CalPERS and they got a good idea of what their next UAL was going to be and actually added that in. I'm not suggesting that, but kind of the inverse of that, meaning if we were to do 100%, do we have any idea what that would come down to with the new UAL? Would it end up being like within the next few months or whatever, turning from 100 into 98 or 97 anyway?
Mr. Chair, I apologize. That was on my list of things to do today. I wanted to call CalPERS and I was just scrambling to get ready for this presentation and I didn't have a chance to get to that. But that is absolutely a question we're going to be asking very, very soon as we start communicating more with CalPERS and see if they have some information for us.
Any opportunity or any chance you think that you would be able to have that as part of your presentation to City Council to be able to say, if we go at 100 with this, it's actually going to be like doing 97, or if we go at 95, it's actually going to be like 93.
I'm going to call them tomorrow, and if they're not on vacation yet, then yes. But the council meeting's on Tuesday after the holiday, so I don't know how far we'll get, but I will try. Yes.
Okay. So I would just say, knowing that 100 is not actually 100, I am leaning towards the 100, but in the spirit of compromise and being flexible and open-minded, I would be open to any recommendation from this commission between 95 and 100.
I would support something at 98%. I just the unknown part of it for me, and I realize that I'm nowhere near the expert that these gentlemen are that are with us tonight. Just makes me think that some smaller number less than that to hedge our bet. The chances of us outperforming or CalPERS outperforming was 2% at 90% and 115 at 100%. We've got somewhat of relief coming based on our mix and our actuarial. So I'm more comfortable with say even as high as 98, less than the 100, and maybe it's a difference without a distinction, but some percentage points less than that. I'd support something around 98.
So then I would be open to that number as well. Commissioners, your thoughts?
Or is the recommendation really just kind of a range to the council, like between 95 and 100? That it seems like we're all on the same page. That we're all on the same page around, with the way the bond is set up, and that the hybrid model is the best. But that we're still a little unsure on a very specific exact number, but that the range of 95 to 100 is in line with kind of everyone on the commission.
We could certainly present a tally to the council. We could certainly present a unified range. However you commissioners feel is the best way to communicate your desires.
How about saying somewhere between 95 and 100, but we're inclined to go closer to 100 and suggest 98 as a figure. I think that's a reasonable way to go.
Like recommend 98, but
I'd be
we're open
comfortable
to
with that.
95 to 100. I would also agree with that recommendation.
I'd be comfortable with that.
Saying something like 98 implies a degree of fidelity that we don't have.
Okay, fair.
Well, on the other hand, I'd hate to recommend 95 to 100 and have the commission city council think that we're just as happy with 95 as we are with 98. So I don't know how best to get that message across. But I agree with you, Steve. We're guessing at what this should likely be, and we have no way of knowing exactly.
And it's ultimately the council's decision. It's we make recommendations and they make decisions.
Right.
I don't see why the motion couldn't have that specificity in it, that we reviewed it or looked at it as 95 to 100, inclined closer to 100, but deferred towards more information becoming available, or what the council obviously has at their discretion. But I think we're sending a message to the council that we would want to be as closer to 100% funding than the lower numbers that were presented of 80 or even 90.
Yeah, I agree.
Agreed.
So would you accept that perhaps in the form of a motion, then make a motion to say, recommend to the city council to utilize the hybrid model, to utilize lease revenue bonds, to recommend a funding of between 95 to 100% of the UAL, inclined towards a number perhaps in the 98 area or region, unless that's something that would be a sticking point for you, Steve.
Second.
Hold on, I'm sorry, don't mean to intrude on the process. So as was brought up before, are we aiming for a 98% funding level, or aiming for 90% refinancing of the UAL, or refinancing 98% of the outstanding UAL? They're two different things.
We were using the percentage ranges that were in your presentation, the 80, 90, 100.
Those are funding levels.
So we're talking about funding levels.
Okay.
Is my understanding. Yes. So I forget the terminology, but friendly addition to
Amendment. Yeah, friendly amendment.
Motion, friendly amendment to the motion. Maybe instead of saying 95 to 100 with preference around 98, maybe the wording would be 95 to 100 with a preference toward the higher end of that range.
I'd be comfortable with that, sure.
Any other discussion, gentlemen? Can I get a second to the motion with the friendly amendment?
Second.
Okay, seeing no other discussion, we will go to a roll call vote. Okay, so let's see, we'll start with Commissioner Marin, please. Commissioner Woodham?
Aye.
Commissioner Solomon?
Aye.
Commissioner Johnson?
I'm leaning towards abstaining. I abstain.
All right. Thank you. Commissioner Wynn?
Aye.
And the chair votes aye as well. Okay. With that, item J1 is now received and filed. Once again, gentlemen, thank you for your very informative presentation and your comprehensive answers to our questions. It was
Quite well.
Couldn't have done it without you.
Have a good evening.
Thank you, everyone.
Good evening. Thank you for the opportunity.
Thank you,
Good luck
everybody.
with your next item.
Thank you.
It's gonna be a long night.
All right. The next order of business, item J2 will be presented by Marnie Ruin.
Good evening again. As you know, the 21-22 proposed budget and the CIP were released on 16th. Past commissioners had asked that discussions begin a little while after that so that the commissioners have time to review the proposed budget. So here we are tonight with our first meeting, and we have a second meeting scheduled 2 weeks from tonight to again discuss the budget. So tonight I plan to give the overview that we gave to the City Council last week. And then in 2 weeks, we'll have Assistant City Manager Mike Wazansky join us. And he can give us a presentation on the CIP budget. And then he can also answer any questions that I may have to defer to him from tonight. So we do have two looks at it. But with that, I'll attempt to share my screen for an overview. So we have both, as I said, both the fiscal year 21-22 city budget and then the 5-year CIP 21 to 26. The budget is established with using the City Council's adopted core values, which you have there. And the budget document itself, this is the breakdown of that. The city manager's budget message comes first. Again, kind of an overview. We have the core budget. So all the amounts that you see in the budget are the core budget. They are pre-decision package. There are 57 recommended decision packages that represent modifications to the core budget. And then we'll be having budget response reports, which the departments are already working on. They'll be included in the agenda packet that goes out tomorrow for the June 1st meeting. So as soon as they're available, I'll go ahead and send them to you and do that each time that budget response reports are made available. Just to look at the high level numbers of the budget. We have a $96.9 million general fund core budget, again, before decision packages. The CIP budget, including carryovers, is $58 million. It does retain the $8.1 million general fund reserve, which is our 8.33% contingency reserve based on the general fund appropriations. Before decision packages, the budget includes funding for 423 employees. That is up from the fiscal year 2021 budget. The City Council, in adopting the budget, adopted it with the vacant positions that were recommended for deauthorization. They adopted it to be the vacant positions would be defunded just for 1 year. So they are back in this 423 number. After decision packages, if they were all approved, we would end up with 422 full-time employees. So it adds some in some places, and then primarily in the harbor funds, which are struggling, as well as the general fund, there would be some reductions from the core budget. So before decision packages, we have a $5.5 million deficit. And with the decision packages, we end up at balanced. It's not exactly zero, but it's less than $1,000 surplus. Some of the decision packages, there's continuation of an enhanced response to homelessness. There's a no cost decision package for the code enforcement personnel to be transferred from the community development department to the police department. There are various decision packages regarding staffing needs. There are also decision packages for various equipment purchases. There's a decision package for legal services for power plant property matters. That's a decision package that was approved in the 2021 budget as a one-time appropriation. This is one time as well, but for a larger dollar amount. Because council opted to fund this decision package in the current fiscal year with open space acquisition funds, that is the recommendation to do again in 21-22. There are decision packages for a King Harbor amenities plan preparation, and then following that, a Seaside Lagoon concept plan. Then the budget is primarily balanced using federal COVID recovery funds. And then as we were discussing during the bond presentation, the bonds saving us a couple $1 million. And then as we talked about in the staffing numbers, there are harbor reductions, not only for the staffing, but also some maintenance and operations reductions. The budget response reports that will be coming out, some examples of those include budget detail, your commission feedback together with that of other commissions. There are quite a few budget response reports over the next couple weeks on street improvements and park improvements. There will be a budget response report on each vehicle and IT equipment replacements. And then one of the budget response reports will be the 5 years of financial scenarios where we give the best, worst, and probable cases where you looked at the assumptions previously. So our budget calendar, we are now the 5th one down. Your first review, June 1st, just Tuesday night, will be another council look at the budget and their public hearing. The public hearing continues to June 8th, and the planned focus is to be CIP. And June 10th is your second look at the budget. And the 14th, the Harbor Commission is going to take a look at the budget. And then June 15th is when we anticipate council taking action and adopting the budget. So really the recommendation tonight is just to receive and file the budget and the CIP. But we can spend time now answering any questions you might have.
Okay. I imagine there's going to be a few questions, and I don't know what you can answer versus what would be better for the city manager. The first question that came to my mind is, it says here that we've got and I'm looking at the city manager's letter here. We're anticipating a $5.5 million budget deficit in the coming year, correct?
Yes.
So is that the best time to be increasing headcount? Hiring back a lot of these positions that we press pause on because of COVID. I know we're coming out of COVID, but per, again, the city manager's letter, revenues are still down and expected some of these to continue to be down for this fiscal year. And yet I see what looks like a headcount going back to pretty close to pre-COVID levels. Are we doing that too quickly?
As I mentioned, this is following City Council's direction as they adopted the 2021 budget. Your recommendation can certainly include another year of retaining those vacancies.
I guess, has there been like a reevaluation of what the needs are based on not only where we are today, but just how the world's changed in terms of each of the individual open slots, or was it just kind of passed back saying let's just reinstate every single open position?
It is just putting back all the vacant positions based on council's direction of, staff had recommended that those positions be deauthorized permanently. Council, when they adopted the 2021 budget, said, no, the vacant positions, we only want to defund for 1 year. We want them back the following year. But
how long ago did they make that recommendation? Because
a year ago.
Okay, so now we've got a lot of new information, so they may not even feel the same way.
Exactly.
Is it our role?
Exactly.
And I assume it's our role as a commission again, we make the recommendations and they make the decisions, right?
Yes. Mm-hmm.
Okay. So I don't know if tonight's the forum to hash these sorts of things out, or if it's in our next review. I just don't know. But that's one of the immediate things that came to mind. On that same line of questioning, we've got promotions going on in, we've got 2 deputy city attorneys that the recommendation here is to promote them both to senior deputy city attorneys. But based on the decision package here, I don't see what the reason is for that. Again, at a time when we're having a huge budget deficit, is that the right time to be promoting staff?
Yeah, so it's not just an outright promotion. It is in the context of the enhanced response to homelessness, and for those 2 attorneys to take on the additional duties related to dealing with the homeless. A promotion is being recommended for taking on those additional duties.
Well, I mean, there's only so many hours in a day, unless you're saying they're going to go from working, an average of 9 hours a day to an average of 13 hours a day. I just, I can appreciate that they're getting new responsibilities. I can see within that same decision package, there's also hiring additional staff, right? There's going to be an individual who's in charge of that homeless program.
Yeah, I don't know if you were able to see the city council meeting where the city attorney questioned council on whether they wanted to continue the enhanced response. And he did lay out all these components in that presentation. So if you weren't able to see it, you may want to go back and look at the council meeting where it was all spelled out.
Okay, and that's fair.
I was able to see that, Marnie. And a lot of the programming for the enhanced response to homelessness has a ticking clock on it. So, for example, the pallet shelter and our ability to do that, we may not be able to continue that program beyond emergency authorization. And some of the other things, if the grants don't come through, then part of this funding would be for grants. So it seems maybe, I understand maybe trying to budget for it, but a little bit premature. It's more like a hopeful idea of this is what we'd like to do, then this is what we know we can do, was the take that I got from it. and that some of these things sort of had a shifting ground under our feet as to whether or not they would continue based on a lot of what ifs. So I appreciate the idea that, you know, the city attorney did do a very good job of laying out what the wish list was, so to speak, but there seemed to be a lot of uncertainty with regard to how long it could go on for. There was, you know, other parts of the city where, like a community services officers and some that were responding to some of the homelessness. Does an attorney have to be the one that responds to some of these services? Can it be somebody in a different department? That I don't know if that was not addressed either. So I'm sorry to interrupt there. I just had Chair Conroy. It was just one of those things where, to me, a lot of these things were maybes or had ticking clocks on them that may not be able to be continued.
And again, your recommendation, you know, can certainly be that, you know, either that decision package is not adopted, or your recommendation could be that that decision package is adopted at a lower level. You know, the options for recommendations are all yours.
Marnie, I think what would help us in our recommendation, certainly the city council and their decision, is whether that you know those positions are held vacant for an additional year or not. Is do we have some idea of what the dollar would be, the dollar savings would be by holding those positions vacant for one more year?
So I looked at it during the process, and if I remember correctly, it's in the neighborhood of $2 million.
That would get us a lot closer to a balanced budget. Okay. Again, I mean, that as long as all that information is available to City Council when they look at this again, I think that would be important.
Marnie, the expense report on page 73 of the book that was sent out shows personnel expenses going up by almost 11%. That is core budget. That's before any of the items we're talking about now.
Right. So that includes several things. But of course, your largest dollar figure in that amount is going to be your PERS unfunded liability. It does also include the, you know, MOUs or salary contracts that were approved. But like I said, the largest dollar is going to be that PERS UAL.
PERS and even the medical insurance need to go up for the gross personnel.
Commissioner Marin, we can't hear you all that well.
Oh, sorry. Let me see this up. But I think also it looked like medical insurance was also just going up across the board, but that's also just reflective of the industry.
That and the new labor agreements, the MOUs, did have some increased funding to the employees for their medical coverage.
So that figure is exclusive of any new hires, any new promotions. That's just mandated in based on labor contracts and so forth, right?
Right. Yeah. It does include, you know, these vacant positions being reinstated, but yeah.
And gentlemen, I'd encourage you to just speak. Don't wait to be called upon, because I'm over here looking at my notes too. I don't want to leave anyone hanging. So just hop right in.
Thank you, Chair Conroy. Marnie, I want to say before we go any further that you're really you're in the middle of my screen. You know, you're Paul Lind right now, and you've got all of us around you peppering you with questions. So thank you for that. And it's just, we've all got tons of questions, and they're going to you, but they're not directed at you.
It's what I'm here for.
Okay, so it's I think perfectly clear to me, and I think everyone else too. But I just want to make that's a blanket statement. We know you're not the one doing this. You're just answering the question.
Thank you.
Wait a minute, I thought she was.
So with that being said, a couple of things. On decision package 3 for our banking services cost increase, we've had Bank of America for a really long time handling all of our banking needs. And when these cost increases come forward, is this from Bank of America? Is it from across the board, a number of different service providers like credit cards and other banking services, or is it the one vendor?
It is both.
Okay. And so with our contract with Bank of America, then, if you work well, is there any notion that we did any exploration of what other vendors might do for us when they come to us with cost increases?
The city treasurer's office does that periodically.
Okay.
They also, and part of the reason we're seeing such an increase is they have, after looking around, had negotiated with Bank of America on our earnings credit rate, where the funds that we have sitting in the bank each night, the amount of interest that we earn on that, they had gotten that to a really good point, and then interest rates dove. And so now we are paying for all of our banking fees, and it's costly.
What is our current earnings credit rate?
Oh, goodness. I will have to look that up, but it dropped at least 6%.
6%? Well,
It dropped.
6% of what it was.
By that
Yeah, I got you. Okay, well, if you could look it up, it would be, I would be curious to know. I know that where I work, we deal with Wells Fargo in a similar capacity, and we're always negotiating with them because they want to keep lowering it. We tell them they need to not lower it. But you're saying the treasurer's office does periodically go out to market and see what other major banks are offering?
They do.
Do you know when was the last time they did that? Because this seems like it might be a good time to do it.
I am not positive, but I'm thinking it was fiscal year 1920.
So not that long ago.
Right.
On that same decision package, it mentions that one of the increased costs is for these credit card payments, because we have people that are paying things with credit cards, and we're absorbing, or we're being charged a fee. Are we charging people to use a credit card?
So we do, and
Good.
if you take a look when it comes out at the city council agenda, we are about to change the way we're doing that. So currently, we are charging $3 per transaction, regardless of the dollar amount of the transaction. And that is only for online payments. What we have been trying to put in place for some time now, and finally we're able to work it out, is a 3% credit card acceptance fee, which means it can be for online payments, or once City Hall opens, when they come in and they pay at the counter with a credit card, we would also charge them there. And so what's going to happen is that 3% will go directly to its Open Edge, which is a subsidiary of Global Payments, is how you'll see that contract on the agenda. It'll go to them and offset our credit card fees.
That's a great idea. Too bad we couldn't have been charging a percentage in the past, because I'm sure we're charged based on a percentage.
Oh man, we have tried. We went down the road with Bank of America, and we were there. We were going live the next week, and they got somebody new involved and said, we can't do that. So
Wow.
then it was starting over from scratch, and
But yet,
so we're finally
All the
there.
more reason to shop Bank of America with somebody else.
yeah, right.
So we are finally there with OpenEdge.
I would just say, does the 3%, does that cover our costs? Because clearly it should be a profit center, but I would think that our aim would be to break even on our credit card costs. We offer it as a convenience to people. And I imagine they can also continue to pay with a debit card with no fee, or is there also a fee?
There would also be a fee for that.
Okay. But okay, so does the 3% cover our costs?
Remains to be seen, but they are telling us yes.
Okay, well, that's way better than $3 a transaction. So I approve. Okay.
Marnie, for package number 16, the fleet maintenance and operations, just wanted to try and clarify something for myself here. These are ongoing appropriations for maintenance on these vehicles. Wouldn't something like that be charged to each department or each area in an ISF fund rather than appropriating it from the general fund into the vehicle replacement fund?
So yes, that happens on a delay though. So they would, the vehicle replacement fund will pay those costs in fiscal year 21-22, and then in fiscal year 22-23, it will be billed out to the departments using those services.
But it says it's an ongoing appropriation. Is that because anything beyond a one-time appropriation has to be referred to as an ongoing?
Well, that's when it'll first hit. So then it'll be every year after that. It'll be ongoing. Both the expenditure from the vehicle replacement fund and then the following year that being charged out to the departments.
The amount listed here, though, isn't net of the amount that was billed out to the departments in prior for acquisitions in prior periods.
No.
So it's just ultimately net zero because the funds fully billed and collected from those departments?
Well, not citywide. Citywide,
No. Yeah.
the cost, but to this fund, yeah.
Okay. So even in this year and then the budget year, we are collecting funds from those departments.
Right.
Okay. On that note, if I could, there's a number of decision packages that reference the fire department specifically.
There are a lot, huh?
There's quite a few, and I meant to add them up, but I didn't. But as you agreed, there's quite a few. So the only point that I'm trying to make as it relates to that is that City Council is currently getting a county proposal for fire. Is that correct?
There will be a budget response report on what that takes to do.
Okay. And that county proposal is going to capture all of these fire department specific costs, would it not?
Oh, without looking at each. Well, the equipment is going to be purchased once. So I would say no, they would just use ours, I would think. But
Okay. So is the model with county going forward in the long term that the city would continue to provide their equipment and they're just providing staff? Is that?
No, I believe they.
I could see how they could adopt our existing equipment.
Yeah, I'm
But
trying
if
to
we're
recall.
talking, go ahead.
I'm trying to recall from our last proposal, but if I remember correctly, they would, before finalizing an exact number, especially in the first year, they would come and they would look at all the equipment, this smaller equipment here, the fire trucks, all of that. And the equipment that would be used by the county or the newly or the new county employees, that they would place a value on and basically give us a credit for
Certainly. In addition to equipment, there's a lot of things here about training, staffing, personal protection devices. The list goes on quite a lot. And I would just put it out there that, and is trying to compare apples to apples as much as possible, that that the city council needs to consider that with the county proposal, it includes the majority, if not all, of the decision package items here for the fire department.
But could they wait that long? To have.
That's a fair point, but I'm just saying it needs to be considered when reviewing the county proposal. That if it were adopted, and even if it can't, it's not like flipping a switch. There would be some time involved if the city decides to go that way. But these costs, or these types of costs, especially, I think most all of them are recurring to an extent. They go away with the county proposal, or they're captured in the county proposal.
Okay. To Chair Conroy's point with regard to staffing at the fire department, if I remember reading it correctly, the plan is to leave the ladder truck at Station 2 manned at 3 people, rather than the 4 people that it used to have. And that's not one of the recommended positions to reinstate, but we're adding 4 part-time non-sworn fire inspectors for a pilot program. I would think that, from my point of view anyway, we would want to prioritize public safety and manning to our fire trucks, our ladder trucks, over administrative duties. And I would think hopefully look at that as a decision. Was this something that was brought to us by the acting fire chief, Chief Kaufman, to leave the staffing as it was and to add the part-time and leave the ladder truck at 3?
Yeah, I mean, he didn't submit a decision package request to reinstate the staffing on the ladder truck.
Okay, so that's why I was left status quo there. So where did the request for these additional non-sworn fire inspectors and other part-time personnel come from? Did that come from the chief, or did that come from the finance department and reviewing the personnel? Where did that come from?
It came from the interim fire chief, taking a look at fire operations and saying the administrative staff of the fire department is just way too low, and requiring the sworn personnel to perform administrative duties.
Okay.
So is the idea then that hiring these people, these administrative staff, is going to reduce the overall personnel costs for the department? Because then the sworn personnel aren't going to have to perform these duties and thereby have less overtime? Is that what we should take from this?
think it would impact the overtime.
And what's the
I believe
benefit?
it's just what they're doing while they're here.
It makes it sound like the firemen don't want to do the administrative duties, so they want to hire some people to do it.
Well, I think that's how the chief feels.
Okay. I'll keep going back to that $5.5 million deficit. Is this the time to hire administrators so that firemen can choose to delegate more of the things they're currently doing?
Yeah.
I don't know.
And once again, your recommendation can be, we don't think we should be spending the money on more administrative staff. We recommend council that you do not adopt this decision package.
Okay.
Marnie, just a curious point. Decision package 36 refers to the property formerly owned by AES. Maybe I missed that. Did the buyer did in fact buy that from AES? Okay.
Is that on same decision package? Is that $709,000 one-time cost for these outside attorneys? Is that the total estimated cost, or is that the cost just to get them going? And there's going to be more bills behind that.
It's the total fiscal year 21-22 cost.
But we expect that this is going to take longer than this year, certainly.
Then it would add to.
Yeah.
When the Cal State Water Board extended the operating agreement or grant for AES beyond the anticipated dark date, following that decision in September of 2020, the city brought a CEQA lawsuit against the California State Water Board that was decided upon by the city council. So this looks like it is the funding of the pursuit of that challenge, and it's probably an initial funding of it. I don't know that we've funded other lawsuits that the city has brought against, let's say, for example, SB 415. If that was appropriated from a fund that was available, I expect that because the area is zoned as a park with an operating a CUP as a power plant for power generation, that we're able to use it get money from the open space acquisition fund, because we are trying to buy acreage there to have a city park. That would be my inference from reading of it.
That's the logic behind it. Yeah, that's the logic that council used when they adopted a similar decision package this current fiscal year. And so staff is just carrying forward that logic.
Marnie,
So that, oh, go ahead.
well, I was gonna, if you're continuing, go ahead. I was gonna change to something different.
All right. Yeah, I have
first,
a quick
man.
question on that same
You first,
decision.
please.
I mean, just to clarify, that $700,000 for decision package number 36 is legal dollars for the city of Redondo Beach to do what? To stop the ongoing power plant? I'm still a little unclear on what that $700,000 is for.
So as you can tell, the decision package is primarily written by the city attorney. And to me, as a finance person, not an attorney, it's a little bit of legalese to me. And I don't think I can really translate it for you.
Essentially what happened, my understanding of it is, when the State Water Board made the decision to grant the extension, the operating extension to AES, the city is saying that when you did that, you violated the California Environmental Quality Act. And because in your analysis of allowing that plant to continue operations. because once through cooling plants damage the environment, use of seawater for cooling is an obsolete technology, and other particulates that come into the air from the operation of the plant, and so on and so on. So it's the city's position that when they agreed to allow the extension, the California State Water Board, they did so in violation of CEQA, and then the city brought suit against the California State Water Board based on allegations that they violated CEQA. So it is to, in some sense, prevent the operation of the plant, but it's combating the extension that was granted for the operation of the plant that was supposed to go dark at the end of 2020. That's my understanding of it.
Got it. Yeah. Mario, I think you hit it. I kept reading it over and over again. It's very legal needs.
It is.
Yeah. And Commissioner Solomon, thanks for clarifying that, because I was really unclear. What are we doing? Go ahead, Commissioner Johnson. Thanks for giving me some time.
Oh, sure. Is everybody okay with 36? Such as it is.
Yeah. As okay as we can be.
Well, I mean, I get it, right? I mean, he knows what the cross complaint is, and we don't know what the cross complaint is. I mean, right. That's the way I would write it if I was speaking to myself. Tiny bit of humor mentioned, but I mean, when you know the subject matter, you write it in a particular way that makes sense. So on decision package 25, the enhanced response to homelessness, there's a mention of purchasing a vehicle for the homeless housing navigator. So that seems like, okay, same as people would point out in this budget situation, we're just going to throw out, oh, let's buy a $40,000 car for somebody. Can we explain what the homeless housing navigator is and why they require a full-time vehicle dedicated to them?
Yeah, so I don't know if you have heard city attorney and council speaking about Harbor Interfaith and Lila, I can't remember her last name, who works for them, and how much good she has done in our response to homelessness. So this would be to hire someone like her on staff instead of using Harbor Interfaith's person. So this person currently, I believe the city donated a vehicle to Harbor Interfaith so that Lila could then transport people. Maybe they need a California ID, and she drives them to the DMV. Things like that, just so they can get what they need. She drives them places, and that would be what this is comparable to.
So usually when we think of vehicles, and we talk about this all the time, adjusting the depreciation rate and things like that, how long they last, that it seems like we pay for vehicles over time. So this is a one-time appropriation to just pay outright for a vehicle, and that goes as a charge against expense?
Yeah, so instead of paying for it over time, we really do it on the front end and pay into the vehicle replacement fund. So all the funding is there when it's time to replace it. For a new vehicle, you have not been putting into the fund. So the first time would be the full cost. And then if it were to be a vehicle that was determined needed to be replaced, then its replacement would be funded over time.
Okay, so
in addition to this.
Yeah, I understand there's been a lot of positive discussion about the impact of the pallet housing and so forth. On package 38, there's $50,000 for a part-time staff member to implement best management processes and create a voter outreach plan. Is there some change to the city clerk's operation or volume of expected elections that's causing something different to happen?
Yeah, so it is that AB 415. So we are doing our own elections now. This past election in March was the first time that it had been done that way. And city clerk, after going through that process, has determined that we need preparation beyond just the fiscal year of the election. We need it the year before as well. So she plans to do a budget response report that details out the needs a little bit more thoroughly than the decision package does.
You don't think, based on the things we learned in the last election, that the current staff could do some of these things? Like voter outreach, and it would require a new individual.
That's how she sees it. Yes. That, her office does more than elections,
Certainly.
Records management and all that. So.
Okay.
Just one final thing, and this is just a math question. On page 116, where we're looking at the operating expenses and I'm not picking on the city attorney, they're all the same. It's actually, I guess this is your general ledger account number, 501090 pension employee share. It shows it just in this one particular instance as an expense of $86,698. So it's showing the employee share of pension as an expense. If we were to look at revenue, is there an offset to equal that out on the revenue side as they pay their share in?
No. So for the classic employees, and based on their MOUs or labor agreements, the city pays for the employee portion. Now, with the PEPRA employees, that is not permitted. And so the PEPRA employees do pay their own employee share, but the classic employees, the city generally pays for those.
Okay, that's an excellent benefit.
Yeah.
Bit of a misnomer. Yeah.
Sign us up. Thank you, Marnie.
Marnie, and looking at departments, since we got there, for the city treasurer's office, the contracts and professional services went up by $33,000. Is that reflective of the increase in the Bank of America and the other things in the decision package we talked about?
No, that's actually your recommendation. Your commission's recommendation to reinstate the
Moss Adams
contract. Yeah.
Okay, so that's Moss Adams coming back.
That's 1/3 of the cost. Another third is in city clerk's budget, and the final third is in the financial services budget.
Great, thank you.
Marnie, do you use Zen City? I see it mentioned in here as a software, and they're looking to get it, continue using it. I looked up Zen City.
Police department does.
Just police department. I looked up Zen City online because I wasn't familiar with it. And one of the things it says it does for cities is budgeting. So I don't know if the police department uses it to create their budget, or if that's just a module that we're not using. Maybe.
They use it for surveys. If you've received service or had an interaction with the police department, then Zen City will survey how that interaction went. And I believe they plan, now that Chief Kaufman is at fire department, I think fire department intends to use it as well for that same purpose, just for surveying.
Okay, so yeah, it doesn't, I mean, they list having a drone, Zen City, some other things. In total, they're looking for $143,000 to continue these technology contracts. I guess it's beneficial or they wouldn't be asking for it. Marnie, I know you're going to tell me I should have seen it in a city council meeting, so I apologize, but if you could just tell me quickly. So Chief Kaufman's the interim fire chief. Is that why we're looking for a new fire chief? He's not transitioning from police to fire in any permanent capacity. Okay.
No, he's chief over both at the current time.
Is he willing to do both jobs for the next 5 or 10 years? Because that would save us some money.
Haven't asked him. I don't know. I haven't heard him volunteering though.
Okay, thank you. Thank you.
Marnie, could you go to decision package 57? There's still part of that I don't understand. The use of bond proceeds for reimbursement. Is this a part of next year's fiscal 22's payment that we're going to have to make, and we're reimbursing ourselves for a part of that?
Yeah, and so, as we get further along in the bonding process, this becomes refined. And if we do make the mid-July closing of the bonds, then as opposed to a reimbursement of our payment in July, it will actually just be the savings between the bond payment that we'll make and the UAL payment that we would have made, but now is going to be paid from bond proceeds. But which way it happens just all depends on when the bonds close, whether they close before July 31st or not.
Okay.
I feel like that $2 million is a bit of a windfall, and it's not even money that we know that we'll get at this point, right? This is all still up for discussion, and it's still all in process. But yeah, I feel like we're counting that chicken before it's hatched, even though it's likely to happen. But more so, I feel like I said, it's a bit of a windfall, and knowing that these pension costs are going to continue to increase over time, is it the most prudent thing to do to take that $2.5 million and spend it all in this budget rather than maybe hold on to it or kind of budget as if that money weren't there?
And, it's just all about, individuals' priorities. If the priority is to fund these things that have gone without funding for some time, and we're willing to use this, if you want to call it windfall, or whether the priority is to hold off on these items with additional costs and not use this funding. So,
well,
again, Commission's recommendation is sought. So
again, that's why I asked the question and the way I did. If it's a prepayment that we're making, that we would make more of if we didn't do the bond issue, but we're doing it because of the timing of the bond issue, I can see why we might want to do that. But if it's simply, are we adding $2.5 million to the bond issue just so we can pull it back out? I don't think that's it.
So the way this is worded, yes, actually you would, but you would make you would be removing from what, say, 100% funding would be lower because you're making our annual UAL payment.
So then could we
do the bond issue? You're going to have this amount. It's just the mechanics of it, whether it's a reimbursement because it's after July 31st, or if it's the bond proceeds paying, making the UAL payment.
So to Jerry's point, could we do the bond issue for $2.5 million less?
Well, that's what I'm still not clear on. If we didn't do the bond issue, we pay, let's say what, $1 million to CalPERS for the UAL amortization for next year. If we do the bond issue, then that $15 million could be, let's say, $13 million. So that $2 million difference, or let's say $2.5 million, so that's exactly the same here. We're doing it for $2.5 million less. That's going to be in the city budget. There's going to be revenue available that we're not paying. So I still don't understand why we're unless we're prepaying part of that and getting the prepayment back. I still don't understand the process.
So one way would be we close the bonds before July 31st, and the bond proceeds are paid from are used to pay both the 21-22 UAL payment and then the balance of what CalPERS calculates as our full UAL.
Right.
And so the bond payment compared to what we would have paid for the UAL gives you this savings. So that's one way it happens, not the way it's worded here.
So then couldn't we do the bond issue for $2.5 million less and still completely pay off our UAL or, our deficit to CalPERS?
We wouldn't have this amount then available.
It sounds to me like we would, because we're paying.
This money, this $15 million, let's silo each of the funds. Getting beyond the idea that the city council hasn't agreed to issue any bonds, and no bonds have actually been sold, and no bonds have gone through any kind of a process at all. To count on a $2 million payment now instead of maybe at mid-year when we actually have it, it seems to me a bad practice to start. But beyond that, you have to silo this, that this money, this $15 million is money that we have set aside to pay our $15 million owed money for the UAL for next fiscal to CalPERS. And it sounds, that's in the general fund right now. And then this money, this $2 million is not so much from the bond proceeds as it is a discount or money that we would not have to pay that's coming out of the general fund that would otherwise be paid to CalPERS. Mm-hmm. And so that's where we're able to use that money, where if it was bond proceeds, as we heard during the presentation, we can't use bond proceeds to put back into our general fund. This is general fund money that we would not have to pay towards CalPERS, or that we I don't want to say getting back, and that's why we're able to go ahead and potentially use it, which is fine if that's the explanation for it. But the problem that I encounter is that there are so many things that have to happen in order for that $2 million to become available. I don't think this is an appropriate time to appropriate it. I think it would be a better served that it actually came to fruition and it was available for the council to go ahead and use at their discretion, or leave unused at their discretion at mid-year when it was banked. And it's just uncomfortable because it's all happening right around the time that the fiscal year turns over and that our CalPERS payment is due and the bonds are all being issued in the cyclone of events. Some of which, nothing always goes perfectly 100% of the time. So I can see where we wouldn't issue the bond for less because it's not bond money, it's general fund money that we're not having to pay to CalPERS. Am I categorizing that the correct way, Marnie?
Yeah, assuming it all happens in July, yeah.
Okay. So that's why I would infer then that we wouldn't fund the bond for less because it's not coming out of the bond proceeds. It's coming out of our existing general fund monies that we would be paying to CalPERS.
Commissioner Solomon, I would just add that the $2.5 million we get back from CalPERS is because we're prepaying or paying early, correct? So our total obligation to CalPERS is reduced by $2.5 million as a result of these bonds being issued. So I get it that we're taking that, essentially that rebate, and we're putting it back where we normally pay our UALs from, right? But I just, again, it looks to me like it's being treated kind of like a windfall, whereas it's only there because of the issuance of the bonds. So even though technically we didn't issue more bonds than were needed, but that's only because the issuance of the bonds and the prepayment of the obligation is what got us this rebate. So again, it just seems prudent to me that we would put that money aside. To your point, I like that, Commissioner Solomon, like kind of table it and see where we are once we get in further into the year. But
I agree with you. I don't think that it's an appropriate transaction within the budget to count on that. And then and I think it's a little bit of a gray area, quite frankly, as to whether or not it is bond proceeds or general fund money. I'm not the expert, and I'm not going to try and pretend to be an expert here. Just based on the discussion we heard earlier, I'm trying to talk it out as to how it could be argued to be part of general fund. But I see your point that you and Commissioner Woodham make, where if it walks like a duck and quacks like a duck, then is it a duck? And I appreciate that viewpoint, and I tend to agree with that. I think it's more like bond proceeds than it is general fund revenue, but I don't think it should be part of covering us right now either. And as Marnie has said, it's up to us to maybe then just make that recommendation that it not be used. And then you'd have the council can worry about coming up with the $2 million.
They'd love that, huh? I think they'd prefer if you came up with the
Marnie, if we don't
this or that.
if we don't do the bond issue, when is our next payment to CalPERS?
In July, we have to make it, between July 1st and July 31st.
Okay, but is that a payment for FY21 or FY22?
22.
Okay, but we say here.
And actually, I'm sorry, we don't have to make it in that time period. That's the period we have to make it in to get the prepayment discount. We can also divide our payment and make one payment each month, but we lose the discount.
But is this statement correct? That the staff is recommending this payment of the 2021 UAL payment be reimbursed. This sounds like an FY22 payment, not an FY21 payment.
Oh, that 2021 refers to calendar year. July of 21.
Oh, okay, got it.
Marnie, what's the present value of the discount with CalPERS? Is it a percentage or is it a dollar amount?
It's a percentage. It's right around 3.5%.
So our risk of not prepaying those monies is 3.5% of potentially 30 to 60 days. Or is it always going to be based upon the total obligation for the year?
So you either pay, it's a prepayment discount. So you either pay 3.5% less, or you pay the full amount over 12 months. If you prepaid the final 6 months, that doesn't get you a discount. It's prepay the whole year or get.
If we chose to not prepay and then we paid it off with the bonds, if we chose to not take the prepayment penalty and delay or defer the payment to CalPERS, and then we were able to go ahead and satisfy the UAL with the bond issue, then the payment becomes the discount becomes a moot issue.
Mm-hmm.
I'm just wondering what the value of the discount is, coming up with the money earlier than maybe holding off and potentially having it later.
Well,
That sounds like the barking dogs of CalPERS at our deal.
This conversation's going to the dogs.
It's a little bit rough. So say it again, please, Marnie. If we don't take advantage of the discount, when would the first payment be due?
it's still in July.
Still in July. Okay.
12th of it every month.
So per my understanding from the presentation earlier, the city's plan is to make the July payment as per scheduled, the full 15 million, and then assuming the bonds go forward, then we'll pay off the balance of the total obligation at some point after that, maybe within 60 days after that, and then we'll get the rebate amount. Or is the rebate amount completely independent of paying off the total obligation? It's just from paying the full year's payment in July.
So it wouldn't really be a rebate. You would just pay that much less because you've already, paid down a bit of your UAL by making our annual payment. So your payoff amount is lower.
And we do that every year, right? We pay it off in a lump sum rather than monthly.
Yeah, so for fiscal year 21-22, it's a $516,000 discount. So it's substantial.
Okay, it is substantial. How do we come up with the 2.5 million then? Is that only because we're paying off the balance of the entire obligation that we get that money back?
So this was written as if we closed after the UAL payment had been made, and this would just be a choice of how much to include in the bond issue for reimbursing ourselves for that UAL payment that we made. But the track we're on now, it's not going to be done, the mechanics that are described in this decision package. It would instead come from the savings of making a bond payment instead of the UAL payment.
Okay, I think I wrapped my brain around it.
No, I haven't.
It gets the variance between the bond payments for the year versus what the UAL payment would have been. So it's a savings, and it looks like their calculation is based on 100% with the hybrid model. That's how you get to that number.
But isn't that savings going to be there? The money for this comes out of the general fund. If we're paying less because we're making the bond payment, the bond interest payment instead of making the CalPERS payment, isn't that money left in the general fund? It's just money that's not spent. So I failed to see.
Right, but the way this budget is proposed, it is spent on balancing the budget.
This makes it sound like we're
It makes a lot of assumptions.
Yeah, it does.
The way I read it, Jerry, is that we're paying the 15 million UAL payment up front, and then when we do the bond issue, it includes this current year's payment, and the cost for the bond issuance or the bond payments is round numbers 13 million instead of the 15 million UAL we paid. So we're picking up that difference, that $2 million for the reduced amount towards the bond payment and putting that back in the general fund. But not putting it back in the general fund to turn around and spend it all immediately.
Yeah, right. Okay.
So at the end of the day, we still spent that same 15 million this year. Kind of the net result is we didn't save any money from the bond issuance in this fiscal year.
We'd be even more underfunded if we hadn't done it. The assumptions
Well,
in
not in the current year, because it's like they said in the presentation, what it does is it kind of locks in what our costs are going to be going forward. So had we paid the 15 million this year, and then we got roughly a $600,000 rebate, our net payment would have been 13.4, which is kind of consistent with what these bond payments are going to be. So, and then in all the future years, it's going to be that same amount. Now, granted, in all those future years, UAL is going to continue to be there. So this isn't our only pension obligation, but it's making the current biggest chunk of it consistent, to the degree that we're doing the hybrid model. And that's why in their analysis, at the end of this whole bond issuance, what is it, roughly 30 years, what may have started off as in their analysis, what would have started off as 100% per their calculations ends up being only covering 70% of the total obligation.
Yeah.
Because of the additional costs that we'll get in the future.
But as this thing is written, it assumes that we know what the interest rate on the bonds is going to be, doesn't it? And we don't. We're guessing at that. So
even the savings that Mike had on his chart today assume an interest rate. I think he put up there what the interest rate was, but
right.
Till they're sold, do you have that?
That's probably based if we did the issuance today. So he's assuming, then that's why he's saying we got to move fast before rates go up.
Well, that's not the only cost of a bond. You have underwriting fees and other costs in there too.
Is that where the TIC came from? Because it's
I think that's how it averages out. Yeah.
Yeah.
So paused for a bit. City's earnings credit rate. Actually, I had it wrong. I was getting my it went from 1.8 to 0.2. So it dropped 1.6%.
That would be
Marty,
consistent with what we were earning on overnight funds, which is probably equivalent to an offset for deposits on hand.
Mm-hmm.
It was nice when we were earning 2%.
Yes, it was.
Good old days, 18 months ago, right?
But then your mortgage rates were much higher too. So they get you one way or another.
But your credit card rates always stay the same.
Isn't that something?
Marnie, on decision package 56, the COVID recovery funds,
Yes.
it has a generic reference to when those funds would be received in the fiscal year. Have we gotten a better idea of in what month or a quarter that those funds would land? Because we're appropriating them now, starting for fiscal end July 1. Are we expecting the 3.4 million in July 1 or at some later date?
Actually, in June, we have started the application process. That I'm reading of the experience of other people, a week, 10 days, something like that before you get the funds. So we're expecting that we'll get them in June, and then the second payment comes 12 months later. So it would be June again.
Are we locked into that figure? Do we know that with a certainty, or is it within a range?
No, we know with certainty.
Okay. So that's less wonky, I would call it, as far as counting on that money for us covering our deficit, or
Right.
that portion of our deficit.
Yep.
When we were looking at the TOT and the expected drop in the TOT, part of that is for the agreement that we have to replenish the Marine Avenue hotels. Is it otherwise indicated that because of the recovery, the figure would be less? Or how much of that I would say do we think is the Marine Avenue hotels is what I'm asking? The reduction, how much of that reduction?
Close to 3 million.
Okay.
You know, in wonderful times.
And we're expecting around, I think it was 3.8 or just under 4. Here was 3.8 is expected versus, it says here 9 million. I remember it being around 8.8 or 9 million anticipated. Okay. And for our leaseholders in the harbor, which is something we may or may not be able to talk about, but are we getting back on schedule where leaseholders are beginning to make payments again with agreements with city council? Or
Yes,
is that
they
still
are.
abated?
They have begun to repay.
Okay. And when they were making changes, did any of the changes affect the participation rates that we have beyond the base rent? So base rent plus participation rate, or minimum base rent of in lieu of participation rate, did those rates change for people?
No, but this assumes just because business was next to nothing, the reason for them not being able to make their payments, that it would be base rent only.
Okay, thank you.
So, Marty, to confirm the intent of J2, are we giving you our comments for each of these decision packages, or are we just kind of like just a Q&A mode?
We are really just in Q&A mode. I'm picturing it that after your next meeting, you would firm up these recommendations to council and have one set of recommendations from both meetings.
Okay. That sounds good. So then I just have a couple of Q&A then. Decision package number 49, 2.8 million for beach city transit vehicles, 5 of them. Is our fleet like it just needs to be replaced, or can this be pushed out to later? This big chunk, is this a good time to replace buses? I don't know. It's a lot of money, so I'm just kind of probing the question.
Yeah, so they have committed, much as the regular city fleet, to replacing on a regular schedule. So this is a portion of the fleet, and there's been a portion of the fleet, going back several years, and it's anticipated there will be going into the future as well.
So
Okay.
those buses look
It
like
is heavily grant funded.
Commissioner Wynn, I'm not trying to jump in, but I just on this bus discussion. So these buses look like they go for about roughly 500,000 a piece. Is there any resale on the old ones to offset that cost, or not?
I don't know the answer. I would assume so.
I would assume so, right? You don't just take them to the dump.
It depends on what it is. For example, when we retired one of the trucks from the fire department a few years ago, that was donated. But when we talked about, I think it was prior to your being on the commission, Chair Conroy, we talked about vehicle replacement fund and how we did that. And we were told at the time, my recollection is that older vehicles are sold. for us to recover some funds.
And where does that show up in the budget? Under miscellaneous income, or?
It goes back into the vehicle replacement fund.
Well, this particular one, because it's the transit vehicles are paid for from the transit fund, go back into the transit fund.
Okay, so we would see that
It
as
would be miscellaneous income.
miscellaneous. Okay, thank you. That's what I was getting
Yeah,
at. Okay. Yeah, it would probably kind of be helpful to see a little bit of that here. For example, like we anticipate these costs are going to be 2.9 million, and we expect to get, I don't know, 500,000 in total for the 5 buses we're retiring. So the net expense is going to be, you know, slightly less. I don't know. It might be helpful.
Yeah, that would be helpful. Just a quick comment on decision package number 43, the parking meters to make them credit card enabled. I think that's great. I will tell you, I have friends that would rather go to Hermosa Beach because they have credit card meters. No one carries cash anymore. Decision package number 41. I didn't know this was an issue where we're having an issue recruiting crossing guards, so we have to put sworn personnel as crossing guards. I didn't know that was an issue, so that was surprising. I don't think I've seen a sworn personnel around my area. Maybe I'm missing it.
I see them at Jefferson School recently. Yeah, uniformed folks out there.
Yeah, they're in Lincoln as well.
Has this been an ongoing issue where we just can't fill crossing guards, or is it just during COVID that we couldn't do it?
It's worse because following COVID in the return. Yeah.
Okay.
It's before, but worse now.
Wow. Okay.
A lot of people who do that are retirees and older folks who would otherwise maybe have health concerns or reluctant to go back out and be exposed. So I think a lot of people were not filling those roles that they might have previously been filling.
Okay. You know, the decision package number 25, back to buying a car for the homeless project. Are other cities kind of, I mean, I don't know the answer to this, but are other cities kind of like transferring some of their homeless to ours, you know, like the pallet housing or anything like that? And if you are, should they be pitching in with the cost? I mean, that's just a thought I have. I don't know if that's, I don't have any proof that's going on, but like if you know, if Manhattan Beach picks up or transfers someone to our facility, and then there's an agreement to do that, we shouldn't be eating all this cost if needed. That's just my thought. I don't know if we have the answer to that tonight.
Yeah, I have heard it stated that the pallet housing is for Redondo Beach residents only. But I'm not clear on how that's determined.
Yeah, same here.
But transients by definition are moving from place to place. They're not technically residents of Redondo Beach unless you just say the fact that they're physically sleeping here makes them a resident. So.
Yeah, when they presented the census results to council, they had one chart on there of people they had surveyed and how they were connected to Redondo Beach. And so I'm sure it has to do with that. You know, either they did have a home in Redondo Beach and lost it, or they have family in Redondo Beach, things like that.
I think a lot of the people that have been transferred into the pallet shelter also are houseless people that the police department or others have encountered on a regular basis, and are attempting to go ahead and get them transitioned into permanent housing. And so I can't remember the name of the program, but it was where you had sort of been encountered twice and offered services and offered an opportunity to be placed or be helped. And so I think some of the people that get moved there are people that have been encountered in the city on an ongoing basis. And whether or not that determines residency or that's how it comes, it's determined, I don't know that.
Go ahead.
I was just going to say, I'm glad that as a city, we're taking steps to address the homeless problem and help some of these people out. It's a step in the right direction. But to Commissioner Wynn's point, it would be unfortunate if other cities or, were saying, hey, go to Redondo Beach, they'll take good care of you, because there's obviously a cost associated with that. That's all. Thank you.
I agree. I think it's great we're helping, but yeah, if other cities are participating, I think they should participate in the cost. That's all I'm saying. Last one. This decision package number. Actually, that's two more. Number 17. The new transit center that's being built by the Galleria. Do we know completion date on it yet? I feel like it keeps getting pushed out.
Yeah, last I heard it was January of 2022, but since that's a ways out, the chances of it getting pushed further out are of course there.
So this $217,000 budget for maintenance and professional services related to the transit center. I guess I'm a little unclear on that. Are we paying staff are we in charge of paying staff to run the place? Is that what the 217 is for?
No, I can't recall the whole list, but janitorial services, lighting costs, just general facility costs beyond the current facility.
So if this is a regional hub, right, I think the intent is a transit center for the region, not just Redondo Beach. Are we getting some assistance, or is Redondo Beach kind of absorbing the whole bill to run this transit center that serves the entire South Bay region? Is what I'm trying to understand. And if it's truly serve the whole region, then I think some of the other cities should help run it. The costs, my thought, but I'm still a little unclear on this, and maybe that's something we kind of figure out later on.
And I don't know all the details either, but I know an analysis is done each year. I'm just not sure whether it's on total cost or the cost of actually running a particular bus line. But an analysis is done as to whether we're getting sufficient transit allocations to cover those costs, or whether we need to additionally get funding from other cities. And so that analysis is done each year. And the last couple years, we've been getting sufficient allocations that we don't need the funding from other cities. But if it switched around, we would go back and get contributions like we had done in the past. Like I said, I'm not sure if that's only the cost of running a particular bus line or if it includes the total costs, including the facility. I'm not sure.
When you say we've got sufficient allocations, does that mean we've got enough money to completely cover our expenses associated with that hub station?
Yep.
Okay, thank you.
Is it possible, Marnie, that we have to demonstrate that this funding is available for when the transit center is available in order to be able to receive the funding for construction of the transit center?
I don't think so. I think this just anticipates it opening during fiscal year 21-22, and some of the services having needing to obtain those, not waiting till it's open, but obtaining them a little bit in advance of opening so that they're ready to go.
Mr. Chair, I have a question. If we are in a Q&A that we're continuing until our next meeting, are we at a point where we're getting ready to gather more questions for next time, or we're going to continue to do this till midnight, I guess is my question.
Mike, well, it's a good question. My goal was to let everybody ask the questions they had of Marnie based on the information we have at hand. My understanding from Marnie, correct me if I'm wrong, is that based on our discussions this evening, in addition to our discussion in 2 weeks, that we will make some recommendations to council at that time. Is that correct?
Yeah, that's what I anticipated. Yep.
So with that in mind, we have another bite at the apple, meaning we don't necessarily need to be here till midnight. So, so as I usually do, if I see where there's no more discussion, I'll give everybody one more opportunity, and see nothing, I will entertain a motion to receive and file for the evening, knowing that we'll have another opportunity to discuss.
Yeah, I think if we have any questions, Marty, could we just email you if we see?
Oh, please
save
do
some time?
that would be wonderful. Yes.
Okay, because I'm with Commissioner Johnson. I don't want to be till midnight doing a Q&A. So,
thank you, Commissioner.
I mean, I'll do it for the good of the city. I will do it. But if we're all, don't want to be on midnight, then
I don't know what time you all start sitting in your Zoom chair, but in 4 minutes, I will be on and off for 16 hours.
To that point, well, I'll make a motion to receive and file J2. Continue the discussion until, I'm sorry, is it J3?
Commissioner Solomon, just a point of order. Before we go to a motion, I'm going to ask Marnie and Doug if we have any public comments.
Oh, thank you. Yes.
No attendees have their hand raised.
And there's no e-comments.
And I will entertain a motion to receive and file.
Make a motion to receive and file and continue discussion in our next hearing.
I'll second.
Okay, and we'll do a roll call vote. Around my screen, Commissioner Marin.
Aye.
Commissioner Solomon.
Aye.
Commissioner Johnson.
Aye.
Commissioner Wynn.
Aye.
And Commissioner Woodham.
Aye.
Chair votes aye as well. Item J2 is received and filed. Moving on to item J3, discussion and possible action regarding fiscal year 2020-21 third quarter budget update. Marnie Rulon, take it away, please.
I will do that. With all the uncertainties regarding the current fiscal year budget, we committed to bringing you quarterly updates. As you be able to see through our discussion here, there's still uncertainty even as of the end of the third quarter. On a high level, both the general fund actual revenues and expenditures are tracking with last year's when looking at a percentage of the budget. Revenues are at 61.3% of budget, and expenditures are at 72.8%. When looking at the general fund's major revenue sources, all are tracking well, actually. The one leading the pack is property transfer tax. So even after this report was written, just a couple days ago, we received our April property transfer tax remittance, and that put us at $200,000 above our budgeted amount, even if we got nothing for May and June. So that one we can count on coming in better than expected. But we've said all along that TOT is the revenue source most negatively impacted by the pandemic. And the question we have is how quickly is it going to go the other direction with things opening up? When will we see a positive impact? But in looking at it, we do think that will exceed the budgeted amount for 2021, which, as we were talking about earlier, is still significantly below normal operations. Then, if you'll recall at mid-year, we significantly reduced the revenue estimates for recreation users pay and for facility rental income. But to partially offset those revenue losses, the appropriations for salaries of the part-time employees running those recreation programs were also reduced. Now with COVID restrictions lifting, whereas we had anticipated they would be in place throughout the entire fiscal year, and they're lifting before that, it looks like we'll be impacted on both sides of the equation. So revenues no doubt will exceed their budgeted amount, but so will the appropriations for the staffing of those programs. General fund, as Commissioner Solomon talked about a little bit ago, is not the only one impacted by the pandemic. The harbor funds have been impacted as well. And so that's why in the 21-22 budget, the decision package we were looking at on the federal stimulus funding, it's recommended that we transfer $1 million of that to the Harbor Uplands Fund so that it can stay afloat. Then in analyzing the expenditure side through the third quarter, it appears that there are a couple of holes that we'll need to plug. One is a decision package we talked about for 21-22. It's also looks like it's going to be necessary for 2021 as well with the banking fees. The second one is for the fire department constant manning overtime. And we're real hopeful that this will kind of do it. The fire department is hiring between 8 and 10 new firefighter paramedics who will start very soon. So we're hoping that will greatly reduce overtime into the future. Then there are a couple other appropriations we'll probably need before the end of the fiscal year in other funds, one being for workers' comp and general liability claims, and the other for harbor patrol operations. So that's just a quick overview of where we stand through the third quarter, and I can take any questions you might have.
Go ahead.
Oh, sorry, Jason. Does the percentage of expenditure for each department include overtime expenses?
Yes.
Okay, thank you. That's the only question I have.
My question related to, you got a sales tax update as part of the, as J3, correct?
Right.
A while back, we discussed a recommendation for increasing the combined total city sales tax to, what was it, 10% or 10.25%? Do you recall?
Yeah, doing a, oh, I can't remember the name of it, but an additional tax.
Right, because we wanted to do it before the state took it, but my recollection is that was approved, correct? The decision from the council was to move forward with that? No, you're shaking your head.
Nope, they voted not to.
Okay, well, that kind of helps me out here. So I was looking at the sales tax update, and I was going to just ask you if that reflected those proposed changes, but obviously it doesn't.
Yeah.
I don't have any other questions. Thank you. Okay, I don't see any other hands. I'll ask one time, do we have any other questions or comments from the commissioners? Seeing none, do we have any public comments?
We do. So, Councilman Obashi is our attendee, and he has his hand raised.
Howdy, commissioners. Thank you, by the way, for your diligent work going through the bond process and questions. I didn't get to watch all of that, but I tuned in when I could, and also going through the budget. I really appreciate your diligent work. I also appreciate how you conduct yourselves here in calling each other by commissioners, whereas some of the council members call one another casually by their first name. So you're really professional. I admire that. I think the council's got a lot to learn from y'all. I appreciate your expertise, and I would encourage you you ask great questions in your further budget discussions. I would encourage you to think about how the budget is proposed and how it could be proposed in the future better. It seems to me, by looking at the budget so far, that every dollar is already proposed to be allocated. There isn't much discretion except to eliminate, and maybe the budget could be presented in a different way. And it kind of begs a lot of questions. Spot on the question about why we're promoting 2 attorneys in the city attorney's office, and really what proportion of the $400,000 needed for the homelessness enhanced response is allocated to that. And again, it begs the same questions that you raised, which is, well, why is it then being handled by the city attorney's office when presumably somebody less educated than a city attorney could be handling some of the stuff around homelessness? So anyways, think about big change because we have a new council as you look at the budget and how it's proposed, and feel free to make recommendations as to what the city council should direct with regard to that too. Thank you very much for your service to the city.
Thank you, Council Member Obaji. Any other public comments?
There's no e-comments.
Okay, with that, I will entertain a motion to receive and file item J3. You're muted, Commissioner Woodham. I don't dare call you Jerry now.
You can't now.
Not now.
Motion to receive and file J3.
Second.
All right, we have a motion and a second, so roll call vote. We'll start with this time with Commissioner Solomon.
Aye.
Commissioner Woodham.
Aye.
Commissioner Johnson.
Aye.
Commissioner Marin. Commissioner Wynn?
Aye.
And the chair votes aye. We will receive and file item J3. Moving on to item J4, discussion and possible action regarding implementation of internal control measures presented by Marnie Rowland.
Yeah, so this is another item that we committed to bringing to you quarterly. The update on where we are with Moss Adam recommendations being implemented. So financial services has not been able to make a lot of progress during this most recent quarter. The items have spent most of the quarter in others' hands. The ordinance creating the Financial Services Department is still in review with the City Attorney's Office. And we just received back from Moss Adams the purchasing card or Cal card policy. Moss Adams also did take a look at our comments on the internal service fund policy. But as they were doing that, it really just became evident that we need to put this on hold until they can do a deeper dive into the allocation bases presented in this policy. So with the assumption that it will get refunded, the Moss Adams contract, we will put this policy on hold and make part of the fiscal year 21-22 work plan the deeper dive. And other than that, pretty much every other recommendation we're working on implementing either hinges on these that I've just mentioned, or there's no change to its status. Again, I can answer any questions you might have on it.
Marnie, maybe I missed it, but I didn't see in the list when I went through it earlier the waste, fraud, and abuse programming, and I think that there was some part of the Moss Adams that did not get renewed, and some of it did. And the waste, fraud, and abuse was part of it that did not.
Yeah, we were able to have them look at these two policies only with carryover funding. But because they would basically, together with a third-party call taker, for lack of a better word, run the fraud, waste, and abuse program, that's something we weren't able to tackle during 2021. But assuming that funding's restored, that will also be included in the 21-22 work plan.
Okay. And then for the reorganization of the city clerk, treasurer roles and responsibilities segment of the report, in the form that you sent as part of the agenda packet, it said that there's been that there's a municipal code amendment that's been ordinance has been drafted, and there'll be a review. Is that something that goes to city council, right?
It will after it's so right now it's that draft ordinance is with the city attorney. We have it with the city attorney asking them, does this conflict with the city charter? Because we don't want to take an ordinance to council that does conflict with the city charter. So we want to wait till we're sure it does not, and then yes, we can take that to council.
And so then they would weigh in at that point as to whether or not a charter amendment would be needed rather than just an ordinance.
Right, or if they want to do the ordinance and follow up with the charter amendment.
Even if they want to do that. Okay,
Yeah.
thank you.
Mhm.
Any other questions or comments for Marnie on this item, commissioners? Seeing none, I'll ask for any public comments. Seeing none, I'll look for a motion and second. To receive
Motion
and
to
file.
receive and file.
Second.
All right, we have a motion and a second. So we're doing a roll call vote, starting with Commissioner Marin,
Aye.
Commissioner Wynn,
Aye.
Commissioner Johnson,
Aye.
Commissioner Solomon,
Aye.
Commissioner Woodham,
Aye.
and the chair votes aye. Item J4 is received and filed. All right, that takes us to our subcommittee report. We've discussed these items at length tonight. I'll just give the other subcommittee members the opportunity if they want to add to any prior discussions or propose any possible actions related to CalPERS or workers' comp issues.
I would just ask if Marnie answered the question for us last time, whether or not the actuary had reviewed or created the report for the fire department overtime, and they had not yet. Did they give you a timetable to have that completed?
No, he gets his stuff from the third-party administrator, and I forget which side it was on, whether workers' comp or general liability, because he's doing the two citywide ones and the fire department all at the same time using the same data. He was having difficulty getting one of the pieces of data from the third-party administrator. So I saw an email trail where he did get some information. I haven't seen whether that was sufficient or not, but he's been sitting around waiting for that.
Okay, great. Thank you.
Okay, are there any questions for the subcommittee? Okay. Seeing none, next we can move on to item K, which is our member items and referrals for staff. This particular time, if you'd allow, I would like to go first and just say that I want to thank Marnie on behalf of everybody here for her 39 years of continuous and dedicated service to the city of Redondo Beach. And I'm sure we all wish you the best in your future endeavors. Marnie, we're lucky to have you working with us on this commission.
Thank you.
All right, and with that, we'll go around the room, beginning with Commissioner Woodham. Do you have anything?
I have nothing. Thank you.
Commissioner Marin? Commissioner Johnson?
None, thank you.
Commissioner Wynn?
Nothing at the moment, but just want to echo Chair Conroy's comment. Congratulations, Marnie, on your retirement. We've worked with you for a very long time, so just want to say it again for everything.
Thank you.
That's it.
I didn't catch a date. When is it effective, Marnie?
June 25th is my last day.
Wow.
We have one more chance
One more chance.
to bask in the glow of Marty Rule.
All right, and we'll round things out with Commissioner Saul.
Not tonight, but thank you.
All right. Okay, with that and no other items, I will entertain a motion to adjourn.
Motion to adjourn.
A second?
Second.
Wonderful. We will do our last roll call vote of the night, beginning with Commissioner Johnson,
Aye.
Commissioner Solomon,
Aye.
Commissioner Woodham,
Aye.
Commissioner Wynn,
All right.
Commissioner Marin.
Aye.
And the chair votes aye as well. That is it. Thank you.
Thank you, everyone.
Doug,
Good night.
All right.
Tammy. Have a good night, everyone.
Thank you. See you in 2 weeks.
Memorial,
Bye now.